Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Moti Oswal studios, middle of the week, and we're waking up to a bump up in terms of US equity. So that's the handover, which is positive. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, morning.
Hi, morning. Folks. Bump up, yes, because they're playing catch up, right? Because it's that Memorial Day holiday.
Yeah.
So finally, they're realizing that July 9 is still some time away. There's a month to play. And I guess equity participants feeling good.
Well, that's right. We'll have to wait by for July 9th to hear. July 4th, I think by then Trump wants a plan as well. So hands full, all eyes on Trump.
All eyes on Trump. And I mean, the man continues to tweet away, not about markets, but about students, immigration.
Yeah.
I don't know if you saw, there was a story which said that he's now threatening students that they must attend classes, otherwise their visas will be revoked. So, I mean, anyway, let's just take it from the top in terms of what you need to know as we start another session. Now, the S&P was up 2%. It climbed over 2%, and it essentially halted what was turning out, which turned out to be a 4-day slide. So 4 days down, and then there was a 2% bump. But remember, this is, of course, we are coming back. This is the first session for US after last Friday. Monday was a market holiday, so there is that bit of a catch-up as well. So S&P was up about 2.05, NASDAQ was up 2.47, the Russell 2000 index was up about 2.5% as well. So that's a broad change. I have to say this, actually two or three things. One, the move might seem very strong, and it is strong. 93% of the S&P 500 stocks ended in the green. But institutional participation apparently was on the lower side. So this was looked like this was more retail and momentum players at play. And then if you just look at it felt kind of squeezy and slightly technical in nature. More than anything, which was sort of, a big time fundamentally driven or anything. So that's the point. Lack of institutional participation and a technical kind of a move on the back of what? On the back of global bond yields sort of starting to fall off a little bit. Now, the 30-year, by the way, which has been the long end has been the focus. The 30-year was down the most. Yields were down there about 9 basis points. We're about 4.95 in the 30-year after staying above 5% for the last couple of days. The 10-year on your screen lost 7 basis points. We're at 4.45%. So come down as well. Now, two reasons here. One, of course, is, remember, this is not just the long end rising, is not just a US phenomenon, as we've been pointing out. It's been happening in UK, Japan, and the US as well. The Japanese authorities have signaled that they will adjust their debt plan in terms of how much debt they plan to issue, which is, of course, through bonds. That is one. And the second, of course, is that there was an auction, as we said, this week, Tuesday, Wednesday, Thursday, in the US Treasury selling bonds. The long end only comes through on Thursday. Last night, 2-year bonds were sold, and there was decent demand. So those are the two reasons. Dollar index was higher, 0.4% or so. This is on the back of slightly risk-off kind of mood, 99.5 plus. Oil prices were down 1%. There is an OPEC plus ministerial meet today, and the suggestion is, and there are reports which say that a third straight production surge could be possible in July, which of course means more oil in the market and perhaps, a lid as far as prices are concerned. There was also, of course, the US Consumer Conference numbers, the Conference Board Consumer Conference numbers which came through, which surprised on the upside. Now, one component, which is the labor component, was weak. And it kind of does point to the fact that, things on the labor side, unemployment, etc., will rise going forward. But the market, for what it did yesterday, chose to ignore it and focused on the broad headline numbers. I'll just quickly circle the levels in, tie the levels in. So on the downside, for the markets, support stands at 24,627, which is the 20-day moving average. It's about a clean 200 points away from where we left off yesterday, and then 24,462. On the upside, I think it's been pretty clear for a while. We need to take out 25,116. That is the first number, and then the 78.6%, which is 25,310. Only the averages have moved on a day-on-day basis, that too by a couple of points. Otherwise, I mean, the numbers, the retracement stay the same. For the Nifty Bank, support stands at 54,576. Which is the first support, and then the 20-day moving average comes in, which is 54,991. Those are the two levels, and immediate resistance here is 55,875. So very, very near term is what we are looking at this point. Gift Nifty will give you a quick sense of how we are starting. It's like yesterday, about 10-point change, absolutely sort of no regard to the 2% bump from last night. But I think that 2% bump last night, it's not showing up in a big way in Asia as well, and maybe for good measure. Surabhi.
Well, Asian market's actually more positive than negative. The Hong Kong market is the one that's under a bit of pressure right now. But the others, I mean, Japan, for instance, is back to gains. The South Korean market is doing very well this morning. The Kospi surging 1.5% thereabouts. And other markets like Singapore, Australia, largely positive. The outlier is the Hang Seng at this point. Now, the whole EU sort of partial rollback, that's been well digested by markets over the last 2-3 days. The next big lookout is the Nvidia numbers, and they come out tonight. And the thing is that Nvidia is probably, the estimates are it's probably going to report about 60-65% kind of top-line growth, which is great. But look at it, look at the distance from the 200% plus kind of growth that it was reporting up until the year back. So will the market continue to have the appetite? The numbers are also very important this time because the impact of all these restrictions with the US, which the US announced on exporting those Nvidia chips to China in specific, the impact of those restrictions will play out. In fact, Nvidia said that it's probably going to be taking a $5.5 billion charge because of those inventory-related issues. And let's see how this plays out. The company's CEO has already gone on record saying that Nvidia's market share in China has come down from 95% to now just about 50%. So that's the big event that's in focus for markets around the world. Now, in Japan, while the equity market's going up, the yen actually has been cooling off. Yesterday, the yen slipped almost 1% versus the dollar. Today, this morning, it's recovering a bit from that loss. Now, why did the yen fall so much in the last 24 hours? Because of reports that are now indicating that Japan could be cutting back from issuances of long-dated bonds. Remember, Japanese 30-year bonds, 40-year bonds, their yields had started surging. Now, it seems the Bank of Japan is thinking that it'll just reduce the issuance a little bit. And that played its part in the bond and the currency markets yesterday. So that's largely the Asian cues. Of course, for us, our market was underperforming all global markets yesterday. Let's see, the bulls will hope it's different this time around with that cut of about 150 odd points. Now, yesterday's flows numbers are very interesting. And remember, they're skewed by those large blocks, whether it was Sagility, whether it was Interglobe or PG Electroplast. So what we have in terms of the flows picture is a very large DII buy number, 10,000 crores, 10,100 crores of positive DII flows coming in. The FPI number is again a trickle, just about 350 crores. But remember, it's being skewed by the block. So we have to watch out for this. Speaking of blocks, more stocks in focus. British American Tobacco, BAT could be selling stake in ITC. They've disclosed that they could be selling up to about 2.3% thereabouts. They'll still be the key sort of shareholders of holding in excess of 20%. But that is something that could be weighing on ITC. Last time when they sold stake, it was a massive trade. And even this time, it will be a block of over $1 billion whenever BAT decides to come to the market. In addition, of course, the numbers as usual. I'll look out for market reaction to Bharat Dynamics. Remember all the defense stocks that have been going up? Its revenue has doubled, but margins and EBITDA is under pressure. So let's see how the market deals with it. Nuvama's come out with very good numbers. Profits up 78%, revenue up 15%, and the margin has surged from 31% to 36%. I'll definitely be watching out for this specific earning reaction this morning. So plenty of excitement this Wednesday. Nigel.
Well, that's right. And if you look at the screen, actually, the sense you get is even though yesterday we had a bit of a down day, it's not yet worrying. And, you'd still fancy your chances if you look to buy the intraday dips. Now, since we have expiry tomorrow, let's first focus on the rollover picture. And the Nifty rollovers actually are relatively higher. 2 days before expiry, D-2, it's at around 60%. The last series, it was sub 50%. While the Nifty Bank, well, that's almost in line, at around 51%. The last series, it was at around 56% or thereabouts. So what do the FIs do, though? They added short positions in yesterday's trading session. So on index futures, they added close to around 14,000 short contracts. There was some mild unwinding of longs. And even on stock futures, there could be an arbitrage at play out, yeah? But they added close to around 47,000 short contracts in the ratio of 3 shorts for every 1 long call on stock futures. How are they positioned right now? The FIs, well, they are net short with close to around 67,000 contracts on the short side, while you have clients that have almost an equivalent amount on the long side. But since we have expiry that's going to be playing out tomorrow, and that's going to be the big monthly expiry, the options data is important. And the FIs, they're writing more calls than puts, so they believe that maybe the higher levels will get protected, at least in the near term, going by the data points, because yesterday they added close to around three short calls in comparison to, to 1 short put in trade yesterday. The PCR. I like the look of this, right? A few sessions ago, it had danced a bit around 1.2, 1.3. It's gradually coming to the lower end of the range. And if the Nifty dips today, the odds are that it comes closer to around 0.7, 0.75 or thereabouts, which in fact tells you that it's not such a bad cue for you, the PCR cooling off. Now, the options data, 24,800 call, 24,900 call, both of them fairly active. Aggressive writing is what we're seeing out there. But the 24,800 put as well was active in trade. That's telling you that lower levels could get defended. And just looking at the 24,900 call, the premium's around 170 rupees. And you plug in the last two sessions, the highs of the day, which comes in that vicinity of around 25,060 to around 25,080. So because of the options data and because of the highs that we saw in the last couple of trading sessions, this becomes the crucial resistance zone in the near term. So that's the mark you're going to be looking at on the upside. On the downside, going by the options data, well, this becomes the important mark, as well as the 20 DMA comes in at around the 24,630. You'll want to buy closer to around this level. So yesterday was a bit of a down day. The data points, though, are not very, very worrying. You'll still say that this market is trending up and you'll want to buy the intraday dips.
Okay, all right. Got that point. Thanks for that, Nigel. Let's actually get started then with the equity call of the morning. Chetan Chetha for Nomura expects choppy markets over the summer as several risk events are on the calendar. He says their fair value estimates for Asia ex-Japan stocks imply limited potential upside and thus a focus on stock selection. He adds on their assessment, they think India within the emerging market space and Japan within developed markets appear best positioned to recapture any reallocation flows should investors diversify away from the US. So it's Japan and India, which Nomura thinks will get the bulk of the flows.
Okay, all right. Let's actually get that flow picture straight up, right? Cameron Brand is with us now, Director of Research at EPFR Global. Cameron, would you agree with that? And what have you seen in terms of flows actually coming in last week? And just put that in context for us. India through GEM funds and India dedicated.
So India is probably the pick of the bunch at the moment in terms of emerging markets. Certainly sentiment towards individual markets. But it's fairly subdued flows coming principally from dedicated funds. So when people do seek Indian exposure, they're going for India exposure rather than through the diversified GEM funds. Japan, not so much. Certainly, we haven't been seeing those flows. Flows for Japan have been fairly choppy for a while. Last week, we saw pretty big outflows. Japan is squarely in the sights when it comes to angst about fiscal discipline, which is having one of its rearing its ugly head, at least for the moment. So of the two, India certainly had the more positive flows over the past 2 months. Japan was, certainly in the picture there or thereabouts, but concerns that there will be some kind of bond market revolt that keeps interest rates high is definitely weighing on Japanese funds at the moment.
Cameron, hi. Great to be speaking with you. So, what's the sense? Because flows that have been coming into India so far, it's been a patchy picture. It's not like there's a tsunami of dollars flowing in. It's kind of one day up, one day down. What's the sense that you get as some of these trade issues roll on?
So the sense is exactly what you just said, that there's limited appetite for emerging markets at the moment until the overall trade picture becomes clearer. Sort of within that fairly uninspiring context, India is frankly doing the best, though there is some positive sentiment towards Latin America that's been evident in the past couple of weeks. And until the dust settles, that's probably how it's going to continue. The focus at the moment is very much on fixed income markets, the recent US downgrade, the less than stellar sovereign bond auctions that we've seen over the past 2 weeks. So flows. The energy is in the fixed income space at the moment.
All right. Hi, Cameron. Good to see you in as always. Cameron, what about the flows to the United States? They were the only game in town just around 3 or 4 months ago. But are you seeing outflows from the US market?
Modest outflows, but yes, sentiment is certainly very flat. We seem to be seeing, frankly, a plague on both houses in terms of the biggest element of the trade dispute picture, which is the U.S. and China. So both U.S. and China equity funds have seen consistent, though not spectacular, outflows now for the better part of the period since Trump stood up and announced Liberation Day. Within that, there's definitely some shifts. We are seeing a lot more appetite for dividend funds on the U.S. side, certainly. And when the stars realign, the money does rush back in. But so many of the stars are out of their orbit at the moment that it's hard for people to really recommit to the U.S. at the moment.
That's a nice way of putting it. Stars are out of the orbit. Stars are going all over the place, including, I don't know, Harvard University, China, Europe. There's so much going on, right, in terms of all the action. Cameron, thank you very much. Good conversation. We'll leave it there for this morning. Thanks for joining in. Well, let's tell you what all we have lined up on the show today. Plenty of interactions coming up. Starting 8:35, we'll have the management of MedPlus Health Services joining in. They'll talk about the Q4 performance. At 9 a.m., we discuss the aviation space, specifically Interglobe Aviation's massive rise. Jinesh Joshi of PL Capital will join in. At 9:20, Trideep Bhattacharya of Edelweiss AMC is our market master of the day. At 9:30, we speak with the management of Hindustan Copper, talk about the Q4 performance and the outlook for this year. And after that, a special Raghuram Rajan, former RBI governor, chats with us at around 9:40 from the sidelines of the UBS Asia Investment Conference. We talk, of course, markets, monetary policy, and the global tariff tsunami. And of course, at around 10:15, we have Mr. KVS Manian of Federal Bank joining in to talk about the FY26 outlook and the impact of the tariff uncertainty.
Well, time to slip in a quick break. We've got a lot of stock-specific action to track for you today. You get to that in just a bit in our special Top 10 segment, but I'm running you through the list. LIC, JK Lakshmi Cement, NMDC Steel, Hindustan Copper, ITI, all of them will be reacting to positive news flow. Add to the list MedPlus Health, Techno Electric as well. On the flip side, ITC, NMDC, and Bharat Dynamics will be reacting to negative news flow. Take that break, come back, get into further detail on all of these names.
Welcome back. As we've been telling you, a lot of markets across Asia are actually tracking gains, including Japan, Australia, Singapore. The Hong Kong market is the one that's weak, down about 0.5%. The implied open is actually not giving us any clarity in terms of direction. It's very flat. Last time we checked was 9 points lower, 15 points lower now. So that's how the start could be. Lots of stocks to talk about. So let's straight away get to the CNBC-TV18 list of top stocks to watch. Starting first with ITC. Nimesh, it's block season galore.
Oh,
and this could be a huge one, right? If BAT decides to go ahead.
Absolutely. Another large block. So yesterday we saw Ganwal selling a stake worth 12,000 crores. And today BAT is looking to sell a 2.3% stake in ITC. And they will raise close to 11,600 crores. The floor price is 400 rupees, which is almost a 8% discount to yesterday's closing price. There was an indication that this large block will come. So it's come today. Interestingly, the stock got ex-dividend as well. And the investors who buy today wouldn't be eligible for the dividend. So that's a clarity there. But a large block and finally BAT stake will fall below 25% as well. So that also a bit of a surprising. But yes, a large block. And I understand most of the investors are anchored towards the lower end of the price band. So you might see a bit of a red to start with on ITC today.
All right, Namesh, thanks a lot. We'll keep an eye out on ITC. NMDC is the other one that could start off on the back foot. That's because the operating performance is a little lower than what the street was working with. So you pull up the big numbers in comparison to our poll, you can see the top line was a little bit better, but the operating performance a little bit weaker. Let's explain this to you. Volumes are mildly higher on a year-on-year basis. On a sequential basis, there was a big recovery. However, the realizations was a disappointment because on a sequential basis, you're seeing that the realization has come down by around 350 rupees per ton. Then how come they managed to beat the top line when the realizations are weaker than expected? That's because of pellets as well as other minerals. Out there, you see there was a much larger contribution. It's normally a very small percentage of the business, but this time around, it was much larger. Moving to the reason of the operational miss is because other expenditure spiked up big time. It was up 69% on a sequential basis, and on a year-on-year basis, it's up by close to around 27%. That could be a phenomenon because of towards the end of the year, you see some kind of rebalances, which could probably be the case. Because if you look at other expenditure as a percentage of sales, that's moved up to around 15%, which is much higher than the 10 to around 12% that we normally see. So going with the red tick out here. However, you need to note that Q1 FY26 would be much better because they had gone ahead and increased prices by around 440 rupees at the start of May. So rare to start, but expect the stock to recover in trade today.
All right, Nigel, thanks very much for that. So NMDC in focus, lots of interest, lots of trading interest around this one, always. Well, Bharat Dynamics is the next one we want to focus on. Ria is here with details. Ria, morning.
Well, good morning. Let's take a look at how the numbers have panned out for Bharat Dynamics in this quarter. Firstly, for FY25, the revenue has gone up by around 41% over the previous year, which is well above the company's guidance of 20 to 25% growth. But on the profitability front, here's where the company has taken a big hit this time around. The FY25 margins have declined by around 850 basis points over the previous year, coming in at just 14%, which is well below the company's guidance of 20% margins. Even the Q4 EBITDA margins have fallen by over 2,000 basis points compared to the previous year, but historically the quarterly margins have been quite volatile for the company. On the order book front, order book is quite strong at around rupees 22,700 crores as per the provisional update of the company, and this is well within the guidance range of an average 20,000 crore order book over the next 2 to 3 years. Export revenues have also continued to ramp up quite significantly for the company, going up by over 7 times over the previous year, but this was off a low base, and the export revenue contribution has also come up to 36% in FY25 versus just about 7% in the last year. But largely because of the sharp miss on the profitability front, the stock is expected to open lower today.
Okay, all right. Yeah, it's also run up, and now there's a miss on the operational parameters. Got that, Ria. Thanks very much. Let's talk about LIC's numbers. Yash is here. Yash, how's the performance?
Well, Surabhi, the expectation in terms of the estimates that we were working with was quite muted. Now, just to put the numbers in one line, the numbers for the fourth quarter have come ahead of expectations, but still, in absolute sense, they do remain weak. So as far as the new business premium, total APE, retail APE and value of new business is concerned, all of them have come ahead of estimates. Margins have come below estimates as well. But as far as absolute numbers is concerned, a contraction seen on all the fronts. New business premium contracting by 9%, total AP down 3%, retail AP down 9%, value of new business contracting by 14%, and value of new business margin on a year-on-year basis, that has contracted 239 basis points, coming in at 18.75% versus 21.1%. I've still gone ahead with green on the stock because A, as per estimates, what the street was baking in, the numbers are ahead of those estimates, and B, the stock has significantly corrected. It's down nearly about 40% from its 52-week high, and hence going with green on this one.
All right, Yash, thank you very much for that. So LIC, I mean, amongst life insurers, and yesterday in closing bell, we had a long discussion with Deepak Shenoy on LIC. It is the laggard amongst life insurers, which have done very well. Nigel, JK Lakshmi Cement, Hindustan Copper, tell us more.
Yeah, and NMDC Steel. What a busy evening, right? Yeah. All right. Let's focus on the good one first. JK Lakshmi Cement. Actually, a very good set of numbers is what we saw there. Operationally, the numbers were much better. I was comparing it with Motilal Oswal estimates, and the EBITDA estimates actually are 20% better out there. A revenue growth of around 6.5% approximately, which was driven by higher volumes because the volume growth was up by close to around 10%. Let's explain why it was a beat. Because if you look at the operational performance, the margins have improved steadily. And on an EBITDA per ton, it's improved from around 660 rupees per ton to around 960 rupees per ton. That's a good 300 rupee increase on a sequential basis. And the street will like that. Yes, they got hit because transport costs did go up. But the benefit of lower power and fuel costs is clearly making the difference, because that was down by close to around 6%. When you have sales volumes going up by around 10%, telling you operating leverage played out there. The profit number as well was up by close to around 19%, while the finance cost was more or less flattish. And they're keeping their debt under check in spite of adding capacity. So the street will like that. They're currently at around 16 million tons, headed to around 30 million tons, going with green on JK Lakshmi Cement. Next up, Hindustan Copper. The stock is already up close to around 10% in the last 1 week or so. But these numbers actually look pretty good. Top line, there's a good growth of close to around 30%. The EBITDA number has jumped up by close to around 17%. So on a year-on-year basis, the margins have come in lower. But on a sequential basis, there's been a good recovery in margins by close to around 300 basis points at around 36%. Other expenditure did dip down by close to around 4%, which is good for them, while the employee cost did move up. However, they got some benefit of lower power cost. So all in all, the numbers actually look good, though the stock has already run up. And valuation-wise, it's hard to justify a stock at more than 50 times its earnings. But we'll have to see if copper prices are going to move up, then this is the only pure play on copper prices. Profit number as well was up by close to around 50%, but that's because the other income did jump up. So going with green on Hindustan Copper. And finally, NMDC Steel. Well, going with green on this one because the EBITDA losses, just take a look at that. We're getting used to seeing a number of more than 500-600 crores or thereabout. That's come down to around 291 crores. So you like that? In all probability, Q1 will be even better because prices have improved and demand for steel as well has improved. So that's why going with green on NMDC Steel. In fact, on Hindustan Copper, we'll have a rare exclusive interview with the management at around 9:30 a.m. to talk about their numbers. Don't miss this one.
All right. Well, that's an important one coming up, and you don't hear from them very often at all. Now, ITI is the next one we're going to focus on. Vinny, tell us more.
So in terms of numbers that have come in from ITI, Q4 FY25 numbers, good set of numbers because the narrowing in terms of losses is quite significant. The losses just come in at 4.4 crores in Q4 versus a 238 crore last year. Revenues have jumped up by around 74%. EBITDA losses also narrowing on that front, 28 crores versus an EBITDA loss last year of 174 crores. There is an exceptional gain this time of 62 crores, but even after that, if you don't include that as well, the losses have still narrowed down significantly. So that is something that is very important in terms for the company. Overall, for the full year also, we're seeing good jump up in terms of revenue, sharp narrowing in terms of losses, and in terms of reduction for losses. When you look at it, this is the lowest level in terms of the loss that we've seen coming in since March 2022. That was the time they reported a profit of 356 crore. And after that, there was a sharp amount of losses that they reported through those years. Now, 4 crore is the lowest amount of loss in those couple of years that we've seen coming in. Stock was up already yesterday 10% ahead of its earnings. So will be interesting to see if they actually keep up with the momentum or there'll be some bit of a profit booking. But given that the numbers were good this time, we could expect some bit of a green.
Okay, all right. Got that. So ITI on our radar as well. Thanks for that, Vinny. Let's move to Ekta. Talk about MedPlus's performance in the fourth quarter. Ekta, morning.
Morning. Well, mixed performance because the margins actually improved, and that was a very strong margin improvement that you've seen on a year-on-year basis. But I'll start with the revenue up around 1.3% on a year-on-year basis, and it was down 3% Q-on-Q. The EBITDA improved by close to 30% on a year-on-year basis, with margins coming in at 9% versus 7.1%, which is a 200 basis points expansion year-on-year and a 50 basis points expansion sequentially. And the profit growth was around 12% Q-on-Q and a strong jump on a year-on-year basis. The company has indicated that there was an 8% increase in the private label sales over Q4 of FY24. Remember, that's a particular segment that they are looking to grow, and they had 100 store additions on a net basis in Q4. So they've met their guidance of store additions, which were around 300 for FY25.
Okay, in fact, we'll have the management of MedPlus Health join us in just a bit at around 8:35. We'll have Mr. Reddy with us to talk about that performance. Okay, more numbers from the mid-cap space. Techno Electric, and we have Vamakshi for the details. Vamakshi, it was looking good?
Well, absolutely, Surbhi. It's definitely looking good for this company. When we look at the revenue, very strong growth out here, 86% higher on a year-on-year basis. The gross margins, though, have contracted by around 91 basis points. But nevertheless, the EBITDA margins have improved, given that there was a decline in the other expenses. EBITDA margins have improved by almost 315 basis points. And the net profit, too, is seeing a very strong uptick of almost 74%. It's not just the fourth quarter, but the entire year as a whole has been very good for this company. Look at the revenue for the entire year. It has come in at 2,268 crores. This is the kind of revenue that the company has posted is at a multi-year high. The EBITDA margins too have been improving for the last 3 years for the company, and currently they're at 15% for the year as a whole. This is much better as compared to what we saw in the previous year, and has reached levels that were not seen as until FY22. As far as the net cash flow from operations is concerned, last year it was negative. This time around it has turned positive. That again bodes well for the company. So given the kind of numbers that the company has posted, going with the green for this counter.
Okay, all right, got that. Thanks very much, Vamakshi, for that. So let's quickly recap our list of stocks to watch today. The ones that have positive news flow are LIC, JK Lakshmi Cement, NMDC Steel, Hindustan Copper, ITI, MedPlus Health, and Techno Electric. Stocks with negative news flow would be ITC because of the expected block trade, NMDC, and Bharat Dynamics. Okay, so that's the equity stock list for the morning. Let's now talk commodities. We have Manisha joining in with the latest. Manisha, good morning. So what's the big headline for you?
Well, profit taking across really, because when you look at the crude oil prices, we seem to have come off here as well. What the markets will watch out for is the OPEC and allies ministerial online meeting on 28th of May. And then 8 of OPEC and allies members will meet on 31st of May to talk about production for the month of July. So this is where the crude prices will take direction from. Apart from that, there are potential new sanctions coming in on Russia. That is what the U.S. has said. And the U.S. also has barred Chevron from exporting Venezuela crude. They can make it, but they can't export it. So there are some concerns coming in from here as well. The same is the case for many of these metal prices also. We are off the multi-week highs that we were trading at. Copper, for one, is off its 4-week highs. It fell 2% overnight. This is after dollar index is trading off its 1-month lows. There also is a bit of a caution ahead of the U.S. Senate debates on U.S. tax and spending bill. And then the markets also are looking at higher surplus globally coming in for copper. Gold as well has continued to see a decline. We did see a 5% gain in the previous week, but this week has slightly been on the lower side. The rebound in U.S. dollar, the risk-on sentiment coming back is something that's weighing on. And then apart from that, it is all going to be about the Fed's latest policy meeting minutes that are going to be released today. And the street will watch out for the first quarter GDP numbers, weekly unemployment, PCE index. So there's a lot of data from U.S. in the next couple of days. That is where the cues will come from.
All right. Lots to track. Manisha, thank you very much for that. So that's commodities in focus. We'll take a quick commercial break here. We come back. We connect with the management of MedPlus Health Services and we discuss their fourth quarter numbers. Very interesting business. So as always, Mr. Reddy will be with us and Himang Jani will be with us on some fundamental stock conversation after that. Stay tuned.
Welcome back. Here with us on Bazaar Morning Call. The first company on our radar this morning is MedPlus Health Services. The growth was a little muted, but margins have improved in the fourth quarter. Profit has been aided by operational improvement as well as higher other income. So that's the Q4 picture that's flashing in front of you. Let's discuss the prospects for FY25. We have Mr. Gagangadi Madhukar Reddy, MD and CEO at the company, joining in. Mr. Reddy, thank you very much for joining in. Good to have you on. So I just read out the fourth quarter performance where margins have improved, profits are looking good. For the year as a whole, FY25, your revenue is up 9%, but the margin has come down from 6.3 to about 4.5%, thereabouts. So let's just talk about, the strategy from here on. You've had a very aggressive store rollout, plan as well. You rolled out, I think, 305 stores last year. This year, you plan to roll out 600 stores. So just walk us through the top line growth, how the old stores are doing, the same-store sales growth, and how the new stores are faring for you?
So the new stores are on track. Typically, we expect them to break even within 3 months, at least 50% of the stores, and then the balance break even in the 6 months' time. So that's on track. We expect their EBITDA to get to roughly around 10% within the 24 to 30 month time period. So that's all good. The old stores, though, which are actually now growing at inflation plus, I think will probably continue to do that. They probably will end up, of course, it depends on the vintage of the store and all, but typically they will grow inflation plus. And that's what we're guiding, going forward.
So inflation plus, when you say you're expecting same-store sales growth to be inflation plus, inflation could be falling to as low as 2-3% in the coming quarters. So just some indication. I mean, are you talking about mid-single digits, high single digits?
I would say more like high single digits.
Okay.
But yeah.
Okay.
Got that. Mr. Reddy, good morning. Always great to speak with you, sir. So how many stores are you opening this year? 26?
This year, we'll probably do around 600 stores. I mean, we have been doing that for a while. Last year was a blip, because of various reasons and because we had to kind of consolidate our back end. And we had to actually increase the capacity of our warehouses and everything else. So that took us a little bit of time. But I think we'll be back on track this year. 600 is a guaranteed, store opening net.
Okay. 2 questions. Where are bulk of these openings going to happen? Let's just get that out of the way first.
Sure. It'll probably be a mix between tier 1 and tier 2. And they will be in the states in which we are, currently present. We are there in 10 states. The new states for us are Madhya Pradesh, Chhattisgarh, and Kerala. So I think a portion of the stores, I would say at least 150 odd stores would come from those places. But otherwise, the balance will go into the states in which we're already there. As I said, we're there in 10 states as of now.
Okay. What about your own, I think this is something we've discussed in detail in earlier conversations, your own generics, private label in that sense.
Yeah.
And you'd said that, it's going to be long-term, hugely margin accretive.
That's it.
What's the share of what you sell now and how is that doing?
Sure. So by volume, and I'm saying volume because, by sales, it doesn't really count. Our drugs sell for roughly half the cost of a branded drug. So if you look at it by volume, I would say even today, roughly 25% of all medicines which we sell come from the MedPlus brand. And this number will be growing, at roughly about 1% every quarter.
Mm-hmm.
So
and how is that?
It'll be 26, every year 100 basis point as a share of the total sales.
Yeah, that's right. Every quarter.
Every quarter. Wow. So that's a very rapid accretion in that sense.
See, we started in June 23 and we're already at around 25% of the overall medicines. So we have had some initial gains. Obviously, the early adopters have come in and now it's going to be slightly slower, but I think it will probably be a slow and steady 1% every quarter is what I'm thinking.
So it's 25%, as a percentage of the overall volume. Sir, as a percentage of the top line, if I talk about your revenue, then how much contribution is coming from private labels right now and how do you see it scaling up?
Sure. So when I said 25% of the overall medicines, I meant, medicines account for 80% of our overall sales and 25% of that would be 20. So if you look at net sales, they'll probably be around 14 or 15%.
14 or 15% of net sales, the top line. Got that. So now, as you grow this, what will be the impact on margins? Fourth quarter, your margins improved quite a bit. But if I see the year as a whole from, that level of about 6+%, you were down to 4.5%. So just walk us through what happened there and what's the outlook on margins this year?
No. Actually, the margins did improve over last year. Operating EBITDA margin actually went up year on year from 3.9% last year this time to 5.3%. So this is margin accretive for us. Every 1% increase in private label increases our overall, this is by volume, increases our overall margin by around 15 basis points. So if I say that we're going to basically increase our overall sales by 4%, that means anywhere from 0.6 to 0.75% would be our overall increase in gross margin for us. Hugely accretive.
So let's just look out. FI, we're already to 26. By end of FI 27, if this accretion goes on, where will margins be?
It's a simple math. So it'll just add.
So 15 basis points every quarter. So 60 basis points a year, and then you. So that's it.
Yeah, that's it. But obviously, what will temper it a little bit are the drag of the new stores. Last year we added only 300. This year will probably add 600 at least. So new stores, since they don't add as much initially, you will see a small drag. But otherwise, the gross margin itself will increase.
Okay, all right. Gross margins will increase. Fair enough.
Since we're talking about a more aggressive store rollout plan, sir, if you could just update us on the balance sheet as well. Cash, if at all you'll need to borrow this year. And how is the store rollout being funded? Is it all through internal cash?
We have zero debt. We have more than 400 crores in the bank.
Mm-hmm.
And we are, accreting margin every year. We are actually adding, profits to this thing out there. So I see no reason for any kind of bank loan. Our 600 stores typically will cost us around 30 lakhs a store. That includes the working capital and everything else. And that's 180 crores. That's covered well within the cash reserves which we have. Not to count of what we are going to add as we go forward. So I don't see any need for raising fresh capital or taking any loan.
So all things put together, since you're adding 600 new stores and the break-even timeline, I think you said is just about 3 months for a store.
6 months.
Which is really...
Yeah.
3 months, right?
50% of the stores break even in 3 and the balance in 6. Yeah.
The balance in, so 3 to 6 months a store breaks even, which sounds very, very good. So all things put together, plus higher share of private labels. This year, what should the top-line growth expectation be for your stakeholders?
Okay, top line has nothing to do with the private label thing. So it'll actually depress it a little bit, I would say. I would just count on the EBITDA just going up. Given that we are at 6,000, adding 600 stores, which don't really add too much in the first year. So I would still say, probably in the 15-20% kind of growth is what we would expect. 15% is what I'm thinking.
At the EBITDA level?
No, at the top line level.
At the top line.
EBITDA, of course, will, grow for sure. Yeah.
All right, Mr. Reddy, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on the program. That's MedPlus. So interesting company, building out a large footprint of physical, stores, medical stores, and in some ways, sort of trying to build out what we have, for example, in the US, etc. Large chains, organized. In that sense, huge. But of course, here we are getting started. 950 on MedPlus. Hemang Jani is with us now with what he's making of things. Hemang, good morning. Good to have you here. I don't know if you have coverage on MedPlus, but if you do, weigh in here.
Yeah, good morning, Prashant. We don't cover this, but I do like the fact that the company, is expanding their store network very rapidly, and consistently, the company has done well in terms of both top line and operating profit. And I just heard, the management saying that the kind of margin outlook that he's talking about is looking quite encouraging, and the break even of their new stores. So I think. Looks to be very interesting from a positioning perspective, but I was a little surprised by the fact that the overall return ratios, despite the pharmacy distribution being a high margin business, is about 10.5–11%. So that is something that I'm really not very sure why it is so low. But overall, I do think that this kind of companies, in the current scenario, would have a good appetite.
Okay, that's MedPlus. Hemang, hi, good morning. Just checking, have you had a look at Bharat Dynamics recently with this whole buzz around defense?
Absolutely, Shilpi. Good morning. I do think that in the current scenario, people would have a slightly, preferred kind of a bias for the, defense names, given, in Indo-Pak escalation. Globally also, we are seeing that more and more countries are opting for upgrade. So in that kind of a scenario, given the positioning of Bharat Dynamics, the missile-related work that they do, there would be certainly interest. But particularly talking about the numbers, I was a bit disappointed by the margins. If you have a lumpiness as high as 50%, from 37% of the margins can drop to almost sub 17%. it will be difficult to gauge how that scenario is going to play out. Also, the top line growth was not that great. Only thing is order inflow part, they are doing well. They have a certain specific offering on the sell side. So maybe some allocation would be good to have, but I will not be comfortable chasing such stock in the current scenario.
I mean, I'm glad you brought this up. That's why I brought up the stock, because the results have been a little disappointing, and the stock has had a massive run up in the last 3-4 months. So take that point. Look at that, 92% in 3 months. That's Bharat Dynamics for you. And it's followed up with Q4 performance that, that's not all full green, you can say. Hemang, speaking of all full green, I mean, these power equipment companies, GE, Vernova, T&D, Hitachi, GE, Vernova itself is up 40% in 1 month. Your thoughts?
I think the whole theme should be is back in the vogue, and I think people earlier had concerns. Let's say for solar companies, the US related developments were not looking that great. But I think when we look at the numbers, when we look at the management con calls, the growth, I think some of these companies do look quite attractive. GE Vernova is a very niche kind of play, nuclear related stuff, good strong order book and growth. So we do like that. I do think that, within the themes, let's say if I have to choose between solar and these kind of companies, certainly solar has its own sort of issues in the current scenario. But GE Vernova and power equipment related, stories are looking far more attractive.
Okay, all right. Hi, Hemang. Good to see you in as always. NMDC's numbers a little bit weakish because of other expenditures spiking up. However, Q1 will be much better because they've taken price increases of around 400 rupees per ton, which bodes well for them. Your view on the stock?
So, Nigel, good morning. NMDC numbers not looking that great. Stock has done well in the recent past, but I do think that, the short run, because of the fact that people want to own up some of the commodity names, Speed, Sale, NMDC, even the large cap names, I would go with something like Sale or Tata Steel, at this point versus an NMDC.
Okay, Sale or Tata Steel in comparison to NMDC. Got it. The other set of numbers that we had was from JK Lakshmi Cement. And these numbers actually looked quite good. I was looking at, the last time as well, they delivered pretty okay set of numbers. But this time around, there's a big improvement of 300 rupees per ton on a sequential basis on EBITDA per ton. The street will like it. Your view?
Positive numbers, Nigel, both in terms of top line, even margin side, about 18.5, not that bad compared to Q4. I think we have to see what kind of outlook do we see from the management for this year. But certainly we do like the company and the current performance. Even in terms of valuations, it is looking quite comfortable at this point. But what stood out for me, Nigel, was JK Cement's number. I think both in terms of current quarterly numbers, the growth outlook, that really stood out. Though it's a bit expensive stock, but I definitely think that people would want to own that.
Okay, all right. Hemang, we got some more questions for you. For the time being, we'll take a snappy break. We'll come back. We'll have our technical experts who will be waiting by. Sudarshan Sukhani and Mitesh Thakkar will be there. Welcome back. Hope you're having a good morning. Well, as promised, Sudarshan Sukhani and Mitesh Thakkar join us on the show. Good morning, gentlemen, and good to see you all in as always. Mitesh, hope you had a good trip. I believe you were traveling, and good to see you back. Mitesh, go first. What's your sense on the markets? I think that from the time you left for your holiday to the time you come back, I think we're still in that same range itself. But what's the trade on the Nifty?
Good morning, Nigel. I think on the Nifty, we have seen 25,100 broadly come into play on the upside and about 24,400, 450 on the downside. I think looks like this consolidation phase might continue. Similarly, on the Bank Nifty, it's about 55,600, 650 on the upside, roughly about 54,250. So I think we're still looking at a market which is sideways and consolidative. Next few days, I would want to see how the market goes, take profits around the upper end of the range, and try to buy near the lower end of the range. But all the signals in the short term point out towards more sideways activity.
Okay, all right. Sudarshan, what about you?
Yeah, good morning. Well, yesterday's price action was very disappointing. The idea was that the Nifty was pushing against 25,000 and any push above that could lead to a breakout of the trading range. But the reverse happened. The markets fell and they are back inside a trading range of about 500 points, 24,500 to 25,000. So now, once inside a trading range after what could be considered as a failed breakout, it becomes difficult to have a view. Unfortunately, today is one of those days when I don't have a view on the Nifty. Well, we'll just wait for a day and see what the market decides to do.
Okay, all right. No view on the Nifty. But Sudarshan, give us a couple of stock picks. I'm sure you have a couple of them for us.
Well, yes, there are stock picks. They are from the mid-cap and small-cap categories, which are still outperforming. So Poonawalla Finance is one of the buys, and I own shares in this company. Buy with a stop under 391. Syngene is a buy, stop under 640. Aarti Industries is a buying opportunity with a stop under 471. And again, from the same sector, Laurus Labs is a buy with a stop under 591. So broadly, focus on small and mid caps.
Okay, got that and got the disclosure as well on Poonawalla. Thanks a lot, Sudarshan, for that. Mitesh, what about you?
I have mix of buys and sell with slightly more bias on the long side. Container Corporation had a good breakout yesterday, so buy it at current levels. If you get a % kind of a dip, add more. Keep a stop below 748 before targets of 810. Buy on Woodco with a stop at 235 for targets of 250. Similarly, Manappuram Finance is a buy with a stop at 226.5 for targets of 240. And Glenmark is the solitary sell call. Keep a stop above 1410 for targets of 1335.
Okay, all right. And Mitesh, hopefully from that trip, you have taken some really good pictures as well, because, I look forward to your photography as well. So hopefully some good pictures is what we could be looking forward to. Thanks a lot, Mitesh, for that. Let's go back to Hemang Jani, though. He's still with us. Hemang, we discussed a couple of metal stocks from the Ferris pack. You said instead of NMDC, you prefer Tata Steel as well as SAIL. What about any view on Hindustan Copper? For the first time in many, many years, actually, we'll be having the management at around 9:30 a.m. on the show itself. Your view on the stock, valuation-wise, not cheap at all at 50 times. However, if you want to play the copper price story, there's only one way. That's Hindustan Copper. The other ones, Hindalco as well as Vedanta, they are more into TCRC. Your take on Hindustan Copper?
I think, as you rightly said, though it's a monopoly and very low floating stock, small company, but the valuation comfort is missing. Also, when you have this kind of a frenzy for some of the PSU names, I'm not too comfortable chasing these stocks. So I would really want to kind of see a bit of a stability, a bit of a cool off before I really venture into it. But within the pack, I think Nalco really stood out for us in terms of numbers, in terms of growth plans.
Nalco, all right. You prefer Nalco on that one. A quick question on Eternal. Yesterday as well, the stock was a little bit subdued. If you want to look at it from a positive perspective, is this entire rejig of global indices is taking place, but bulk of it is getting lapped up. DIIs have 24% in the company, and mutual funds, active and passive together, have 19% out of that. So, the selling is getting absorbed gradually. I think on Friday, we'll have another MSCI rejig, which will be close to $500 million of selling. Post that, will be interesting to see what the stock does, because the QIP was done at 250 rupees. What's your view at 225?
So, Michael, as you said, there are technical factors in the selling, and this came as a bit of a surprise because the sense one was getting was that the selling will not be that significant. So if you see a meaningful correction in the stock, let's say another 3-5%, surely it would present a great opportunity, because I think overall in terms of performance, numbers, things are looking good. On the quick commerce side, it may take a while, but I think the market has accepted that, and still people are looking out for growth-oriented, fintech. So surely would be a buyer at any correction.
Okay, all right. Hemang, stay with us. What we're going to do is take a quick commercial break here, but just also want to quickly tease out that we're very excited to unveil our brand new global business news channel, the all-new CNBC-TV18 Prime, which brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime, 12 noon for the Global Reset, and then Global Lens at 8:30 every day, Monday to Friday. Okay, welcome back. There's about 3 minutes to go for the pre-open session, and I think the GIFT Nifty is not indicating a big move one way or the other. So that kind of a start. Then we'll see. Overnight, of course, handover has been pretty positive. Let's focus on some primary market action as well. And SEBI is likely to clear HDB Financial IPO. Now, this is a big one from the HDFC Group. Ritu is here with what she's picking up. Ritu, morning.
Good morning, Prashant. This is going to be one of the largest NBFC IPOs that we've seen in recent times, apart, of course, from Tata Capital's IPO, which is yet to be cleared by SEBI, but HDB Financial, which had filed its DRHP in 2023 and had faced a lot of delays because of questions about a potential violation in the Companies Act, which related to a private placement of shares to HDFC Bank employees that had triggered classification concerns. Now we understand all of that has been clarified, and SEBI is set to give its green flag to this $1.5 billion IPO, which will comprise of about 2,500 crores in fresh issue and 10,000 crores offer for sale by the parent, HDFC Bank. Keep in mind, HDB Financial has been identified as an upper layer NBFC, which means, as per RBI norms, it is mandated to get listed by September this year. Apart from that, a draft circular on separation norms will also require HDFC Bank, if it is approved in its current form, to pare its stake in HDB Financial to 20% over a period of time. So therefore, this IPO is very critical for both the parent and and HDB. Apart from this, there are two other IPOs that we understand will also be cleared by SEBI very shortly. One is Hero FinCorp, which had filed papers for a 3,668 crore IPO in August. And the second one is Vikram Solar, which is a PV manufacturer based in Kolkata, for a 1,500 crore IPO. These are the other two ones that are in the pipeline. But for Tata Capital, which again has the September 2025 deadline to get listed, it looks like it may take a little longer.
Okay, all right, got that, Ritu. So plenty of action on Primary Street, it seems like. Thanks very much for the update over there. We still have Hemang with us, and we'll start getting the pre-open rates any second now. Hemang, so earnings season almost winding up. Tell us, from the mid-cap universe, what were the one or two earning stars that really stood out for you? Where stocks warrant a buy, looking at the numbers?
Yeah, Sukhri, I think for the overall market, the earnings season has been quite okay, though the expectations were on the lower side. So what stood out for us was companies like UDS, which is a managed services outsourcing part. I think they delivered very good, strong set of numbers. PLS Limited, which is a visa processing company, that also I think the numbers were very strong, and we do like that theme and that entire sector per se. We do like something in the auto ancillary space, company called as SJS Enterprise, which numbers were okay, but I think they have got a big breakthrough. Hero Motor, they have been able to kind of manage to get their client list. So I think these are some of the mid-cap names that we like at this point, where the numbers were very good.
Hemang, I missed the first one. You said BLS and SJS. What was the first one?
UDS, Traded Services.
Okay,
UDS.
All right. Got that. Before we let you go, we'll be having a full-blown discussion on this in just a bit. So let me ask you as well. Interglobe Aviation, right? And yesterday in Nimesh, we were all just talking about it, that market wisdom used to be that you can never make money out of aviation stocks, and Interglobe has turned that wisdom on its head. What are your thoughts now? Looking at the stupendous rise, is it too late to get in? What to do? They have virtual monopoly, we know that, but it's about the P&L and the operations.
Not just about making money, but really solid money when it comes to Interglobe Aviation. And I do think that this year, this financial year, both in terms of price performance and in terms of earnings, this would be the best performing stock on Nifty by far. Given the new airports are being opened up, the international presence, there may be 1 month kind of a issue because of that airspace thing and certain cancellations. But Interglobe, I think by far will be the best performing stock in Nifty this year.
By the way, Hemang, any thoughts on Jio Financial? Was the top gainer yesterday on the Nifty. Of course, that approval has come through on the mutual fund business side. Anything here?
Expectations are high, Prashant, but it's all about different business company getting the approvals and this and that. But you can't justify the current valuations in the market cap. So would rather prefer something which is delivering. This quarter we have a whole host of companies, be it financial services or many sectors that are performing and available at a much better valuation. So not a big believer of this pedigree and all of that.
Okay. All right. Got that, Hemang. Good to be speaking with you this morning. Thanks for all the discussions and the ideas there. You have a good trading day. Well, the pre-open rates have started to trickle in, and right now it's about a 70-point drop on the Nifty, but let's see, usually it tends to settle. The sensex is doing better. The cut on the sensex is just 0.2%, so we'll probably have a quiet start. Watch out for ITC because of this BAT trade, British American Tobacco. ITC, in all likelihood, is going to open weak. 3% lower is what we have. Remember, they're looking to sell about 2.3% stake, and the value of it could be well over $1 billion. Aside of ITC, Jio Financial, by the way, the stock that we were just discussing, it's still latching onto some momentum from yesterday. So still about 1.5% on the higher side. Now the Nifty is settled, very quiet, about a 40-point cut. So neither here nor there. Quiet opening is what we're probably in for. But let's go back to that conversation around Interglobe Aviation. Now, the company's co-founder Rakesh Gangwal sold about 5.7% stake in Indigo airline parent Interglobe Aviation for almost 12,000 crore rupees yesterday. This is the sixth large chunk that he has sold since 2022 via block deals. And now he has just under 8% stake in the carrier. Now, how should investors look at the rise of Interglobe Aviation? Almost a five-bagger in the last 5 years. Jinesh Joshi, research analyst at PL, is joining in. Jinesh, thanks for joining in. Interglobe is one of those stocks that has probably many people feeling FOMO, because the narratives always were that, it's too closely linked to the volatility in crude prices, taxation could be changing, it's a sector that could be controlled by government at any point in time. Generally, they say globally aviation doesn't make money. Interglobe has defied all of these concerns. Your thoughts, and whether now there's any point looking at it at all, or is it too late? The party's, is it ongoing? Is it close to getting over, or has it just started?
No, definitely it's not over. So, if you look at the pricing power of Indigo, if you look at yields over the last 3 to 5 years, they have been in the band of about 5 odd. In fact, even in this quarter, if you look at the yield, it was up by about 2% versus their guidance of about low single-digit moderation. So, as long as the pricing power stays and the fact that the AOG is expected to come down in FY26, which is hovering at about 40 odd currently, we think with the improvement in the cost structure, and if the pricing power remain intact, you will see the journey of upside continue from here on. Obviously, the month of May will have some bit of negativity come through because of the geopolitical tensions. But I think these are all near-term aberrations, and we believe that the upside should continue from here on.
What's your target?
So our target is about 6,100 on the stock. We value it about 11 times September 26 EBITDA.
Okay, yeah. And so you're in sync with targets on the street. I'm just reading out the targets. Citi's got a buy call, 6,500. Morgan Stanley's got an overweight, 6,500 again, 6,502. Jefferies buy 6,300. PL, we've just heard another target of 6,000 plus. Investec is the only one who has a sell call with a target price of 4,050. And they're saying that the Mahakumbh and the Pratt & Whitney compensation tailwinds, they'll phase out in this year, which is why they're an outlier. They're perhaps the only bear in town. But otherwise, targets are still north of 6,000.
But they're not sky high, on the bullish side even. This is
still about $900 to $1,000 from
10%,
where we are.
12%, 15%. Max 15%, right, on the upside.
See, that's a bull market.
Go.
15% is not enough.
Go big or go home. Anyway. Jokes aside, just a quick word on some of the basics, Jinesh. Two things. One, how many new flyers are coming into coming in every year, new flyers. Do we have that data? I mean, what's the rate of growth in this market? And the second is, will competition, do you think it'll get its act together? I mean, the Tatas, there is, of course, then there are the other ones, but it's much smaller. That'll take time. What is your sense?
Yeah, so as far as the new flyer question is concerned, if you look at the month of April, we saw about the domestic passenger growth being at about 8.5%. Even historically, if you look at the numbers since the last couple of years, we have seen a mid-single digit kind of a growth in the domestic passenger traffic. So I think that is a pretty good number to look at. Even if you look at their guidance in terms of new plane additions, they are guiding that they'll add about one plane each week. So even that is a very good number if I were to think through from a long-term perspective. So overall, I feel in terms of the number of flyers, definitely we are seeing good guidance from their side.
And what about competition?
Competition, oh yeah, sorry, I forgot on that part. So see, if you look at the current market share, it is at about 64%. When Indigo was at 60%, I think Tata's put together were at about 20-25%. And you had SpiceJet at about 5% and Akasa at about 5%. And then there were questions that from 60%, from here on, the journey could be a bit difficult. But from 60, they were able to kind of claw back their way to about 64 odd percent. From here on, domestically, no doubt the competition is stiff because the other players are definitely now much better in a much better position than what they were earlier. So to that extent, yes, competition has slightly heated up, but that is why, I mean, if you look at their overall trajectory in terms of expansion on the international side, I mean, they have about 30% of their ASKM on the international side currently, and the long-term picture is to take that number to about 40%. So international definitely will provide them wings as far as competition is concerned.
All right. Hi, Janesh. Good morning. Good to see you. When if people are going to fly more, they'll require more luggage as well, right? I think you track the luggage space as well. What's your take right now? You've been quite optimistic on VIP. The stock has been a big underperformer, but it's bounced phenomenally from the recent lows. Your view on the luggage space and view on both these two names, VIP as well as Safari.
Sure. So if I look at this quarter, I think the performance was subpar. The EBITDA margin was at about 1% odd. The top line growth was in the negative territory. But if you look at their overall cost structure, we have seen quite a bit of improvement come through, at least in 3Q is what we had witnessed in 4Q, that structure got elevated a bit, and that is why you saw the EBITDA margin succumb to about 1.5%. But from here on, with some kind of price hike that is being taken in the e-com channel, the fact that they are focusing more on premiumization from here on, and if you see some kind of growth come through in FY26, even if it is in a mid-single digit kind of a territory, and if the gross margin improves to say about 48-49%, if you look at FY25, they were somewhere closer to about 46-47%. You can see some kind of an improvement come through in terms of the overall performance and obviously the stock price as well. Safari, I mean, yeah, this quarter they did well. I mean, the gross margin was at 49% despite the competition that we are seeing. Even Samsonite has become very aggressive on the mass side, whereby you are seeing certain ad for convenience come through in IPL as well. So despite a stiff competition, a 49% GM definitely is very commendable. And the fact that now they'll have their new plant operate at full capacity in the next year, at least in the initial 6 months, there could be some minor hiccups. But overall, I think 26 for them could definitely be good, given the fact that their new plant at Jaipur will kind of start kicking in.
Janesh, very quickly, just to wrap up back with Interglobe, just leave us with the key numbers to watch. For this year, what is the kind of top-line growth and yields, which were as high as, I think, 5.3%. As of Q4, because there are some brokers indicating that yields will soften in the coming quarters. Where do you see yields this year stabilizing? And the EBITDA margin was, I think, 31% or so. Where should these metrics be in FY26 since you have a bullish call?
Yeah, so if you look at FY26, our top line growth is about 10% odd. So they should be at about 88,000 crores in terms of top line. As far as yield is concerned, see, they ended FY25 with about 5.2, if I remember right. We do not expect much improvement from here on, given the fact that competition is already stiff. So we are at about 5.1. But the improvement will come in the cost structure, given the fact that their damp lease count will come down as AOGs are expected to decline. So an improvement in the cost cost structure will kind of help improve their EBITDA margins. We are at about 25-26% as far as EBITDA margins are concerned, and our bottom line estimate for FY26 is somewhere around 9,200 crores. So yeah, these are the broad numbers for Indigo.
Okay.
All right. We'll leave it there. Thank you very much for joining us. It's a pleasure, and we'll speak again as we continue to track the journey. And it's been, a strong one at that. Let's just get the calls out of the way. Sudarshan is with us with what he'd want you to do. Sudarshan, morning.
Morning. Buy Syngene. Keep a stop at 640.
Syngene is Sudarshan's call. Mitesh, what about you?
I'll go the buy on Concor for targets of 810.
Container Corporation, that is Concor, with a price target of 810. Nimesh is here. Thanks very much, both of you, with what the standout brokerage report of the day is. Nimesh, morning.
Hi, morning, Prashant. Today's standout is on Aarti Industries, a double upgrade from UBS to buy from sell, and they have raised the target price to 625. The earlier target, I think, was 615. But interestingly, their earlier sell call was largely on the back of weak chemical cycle and drag on the MMA business. That is going to change from here on. That's a big call from UBS. And they believe steady improvement in terms of businesses on the back of the new CEO's initiative to optimize costs as well as drive growth. So they're expecting three things to happen from here on. One, the chemical cycle to improve gradually because of low inventory. So that's the first thing. Second, they also believe steady uptick in the MMA volumes, and that's clearly visible in the last 2 quarters of the earnings as well. And third, strategic initiatives to improve the efficiency. The stock valuation-wise is still below its 5-year average, EV to EBITDA. But do remember, the stock has rallied in the last 1 quarter from 380 to 480. But a meaningful upside, a meaningful upgrade from UBS today to a buy, and they've raised a target price of 625 on Aarti Industries.
Okay, all right, got that. Ramesh, thank you very much. So Aarti Industries is going to be on our radar. Stocks up about 2.5% in the pre-open right now. The other one that we discussed, Bharat Dynamics, we were discussing that with Hemang. The fact is that the numbers are a little disappointing, more than a little disappointing on margins specifically. And this after a massive run-up. So therefore, watch out for this. Could be starting lower. And the other one, of course, is going to be ITC. Just taking a final check. ITC is down 3.6%. That's how we are gearing up for the start. By the way, a lot of tech is doing well. Nasdaq's up. Not that there's ever any comparison with the Mag 7 or with NVIDIA, but in general, the morning seems to be looking okay for Infosys, TCS, Wipro. Looks like the leadership pack, at least at the start.
Absolutely. And that 2% pop on the Nasdaq, I think, showing up in some ways. And yields are off. That's the big trigger for the move that we saw last night. So we'll look at indices first, then we'll, of course, look at individual stocks. We've got a couple of seconds to go for start. We'll look at where we are at. So 24,840, 24,850 on the Nifty. It's absolutely flat. Nifty Bank is up about 0.1%. Sensex is absolutely flat as well. Small cap index is up about 0.4%. And I think the mid cap index will come up as well. By the way, yesterday the Nifty was down 0.7, Mag Nifty was down 0.3. The mid and small cap indices were higher. Small, but small up. The direction was green. So that's the picture. Nifty Bank is now slipped into the red, and so was the Nifty, which is down about 0.16%. Heat map to give you a quick sense of where we are at. By the way, the block deal, ITC block deal has gone through, and 15,000 crores, 3.8% lower, 2.5% equity changed hands. It's there. It's mixed. So you've got about 35 odd names which are lower, and about 15 odd names, maybe a little more, which are higher at this point in time. We're just talking about Geo Finance. I think that's the top gainer once again after yesterday. Surabhi.
Yeah. By the way, this is that earnings season where the fag end is also giving you earnings patakas, and we have one today. Techno Electric, look at that stock. 10% on the higher side, moving higher. Actually, a lot of the earnings reactions are positive, and we'll come to that in just a bit. But on the large cap screen, Geo Finance is continuing its good form from yesterday. 1.5% up. Tech, like I said, has started off on a good note. Infosys, Wipro, HCL Tech, TCS, all of these stocks, anywhere between 0.5% to 1% is what you're getting. Good start for Bharti Airtel as well, 0.6% higher for Bharti. Banks are sitting on the fence, not very clear in terms of direction. SBI, 0.2% higher. Let's look at HDFC Bank, 0.25% higher. And then there is ICICI Bank, which is slightly lower. Bank Nifty is absolutely flat. Let's see what's pulling the index on the downside. JSW Steel, 1% lower. There's Titan, there's M&M. Shriram Finance, Hindalco, IndusInd Bank, Reliance itself is slightly lower. And then there is L&T as well. So basically, those are the early trends. Some of the commodity plays like Hindalco, JSW Steel weak. Auto is seeing some profit taking, and big stocks like Reliance and L&T keeping a lid on the gains this morning. Nigel.
Well, that's right. A few stocks actually that are doing well from the broader markets. ITI, the stock was up, but the numbers look quite good. The stock is up another 5%. It's one of the top volume movers today. EPAC, that one as well has opened up, gap up, big gains being seen out there. So good move is what we are seeing. MedPlus, we just had the management on the channel. So that stock, in fact, is reacting favorably. They're talking about the profitability improving in the time to come. Big bazooka move up close to around 8%. Triveni Engineering, we'll have the management in the next 60 to around 90 minutes on the channel itself. Well, they as well reported a pretty good set of numbers, 7.5% up there. LIC, there's always that fear with regard to the supply overhang. Stock has been a relative underperformer, but for now at least the stock has opened up with a gain of close to around 3%. As Yash said, he was going with green. On the flip side, NMDC, other expenditure spikes, realizations took a harder hit than expected. So that's why that stock has opened up with a cut of around 2%. But watch that one. If commodities recover on the whole, then maybe in fact this one could see a bit of recovery because the first quarter of this fiscal will be better. DCX Systems, the stock has opened gap down close to around 5% lower because the numbers were weak. But it appears DCX Systems is the story for FY26 because the order book is the highest that it's seen, close to around 3,000 crores. So let's keep an eye out on that one. Suraj Estates, numbers came out, weak set of numbers. That stock, in fact, is taking a knock as well to kickstart trade. And I think a couple of other notable names that came out with set of numbers. JK Lakshmi Cement, numbers were good, but the stock has seen a 10% run in the last 1 month. So that one, in fact, comes up for you. And Precision Camshaft as well. I think we have a shade of green out there. So it appears the street is looking ahead on a couple of these names. Surabhi?
Okay, just some more names. Agility, 4% lower. Yesterday, remember, there was this block that happened. Down about 4% again today. And watch out for a lot of the railway stocks. Railway stocks are buzzing. Last I checked, most were up and about. Your Aircon, Railtel. Let's just pull up some of these stocks. RVNL is coming up on the screen. There's a bit of a tailwind here. So 2 to 3% on these stocks. PG, Electroplast recovering after yesterday's moves. Yesterday, of course, promoters sold a little over 5% stakes. The stock was under some pressure. This morning, it's up about 3% as we speak. Overall, extremely quiet and flat. The Nifty not going anywhere. About 11 points on the lower side. Okay, so let's straight away get to our market master of the morning, Pradeep Bhattacharya, CIO Equities at Edelweiss AMC is with us. Pradeep, thanks for joining in. Let's straight away get to the earnings math. Are you happy with the fourth quarter overall? I can tell you that, we are pleasantly surprised because usually at this time, the fag end of the earnings season, you get all the misses, all the negative numbers. But, look at this morning. Stocks like Triveni, etc., MedPlus, plenty of excitement and good movers here.
Yeah, I think in and around the result days, one should look at these movements more as positioning ahead of results more than anything else. But I would say if I look at the result season on the whole, I think after a fairly disappointing December quarter numbers that came through in the form of the gap versus expectations, in this time, it's been broadly in line. So we'll still have on net balance an earnings cut of maybe 1 to 2%. But last time it was kind of fairly varied and fairly strong. So from that perspective, I would say broadly earnings have met expectations. And in the context of what's happening globally on the geopolitics side and also in India, that has held the market's nerves quite well of late.
So for the stocks you own, I mean, whether it's your universe or even if you talk about general Nifty earnings, what is the expectation that you have for this year, FY26? Yeah. And has the risk of downgrades receded? My basic question is that will earnings give us the ammunition to take the market substantially higher?
Yeah. So I will start with the earnings and then lead it on to the markets. My working hypothesis is that the earnings would actually come back to the fore in the form of earnings upgrade, which we started, on the downgrade cycle somewhere in the middle of last year. And we will kind of cross that over and finally get into an upgrade cycle in the second half of fiscal year 26. This is driven by mostly 3 or 4 positives which have happened in the light of so many geopolitical negatives that we have seen. One is that oil has cracked almost 25% plus, which India being a big importer is a big positive from a consumption standpoint. Second, inflation has come off about 100 basis points overall. And third, rate cuts, 50 bits so far down, probably more to go. And finally, the impact of the middle class bonanza that we saw in the context of union budget announced by Honorable Finance Minister, that has not yet kicked into gear. So I think from a back half of the year standpoint, the ducks are lining up quite well in general for the economy and particularly for the earnings. Might I add, of late, of course, monsoons have arrived a couple of weeks in advance. If they stick to the plan, then that will also kind of be good from the rural economy standpoint. So I think, give it a couple of quarters, economic decision making has started in India. We will see that translate into earnings in the second half of FY26. That's why we are not negative on earnings overall. However, valuations today are fairly close to September 24 peaks. And earnings still have a couple of more quarters to go. So net, I think from here till about the time when we see earnings come back, you might see a bit of a plus minus 5% market kind of a situation. That's our prognosis of earnings and markets, Surbi.
By the way, look at MedPlus. I think it's up 6%. We had the management with us. It's back. It's into 4 digits now. So interesting. Off the high, by the way, but still holding above the 1,000 rupee mark at this point. LIC, of course, is the other one. Is the number 2 volume-led gainer right now with a 4% pop. The big underperformer within life insurers in India. The private ones have all done very well. But this one is not. You'll hear from the Hindustan Copper Management. That stock is also up about 3%. Techno Electric, I think we spoke about it earlier. PG Electroplus is another one which is up about 2%. There are these RITES and IRCON. RITES is up 6 and IRCON is up about 2%. So there is a fair bit happening, although it's not showing up in any meaningful way as far as the index is concerned. Sudeep, good morning. You know, anything out of the in the defense space that you own, that you like? You know, I was looking at, and it's not just the HALs of the world, right? There are smaller companies. A company called Centum Electronics was up 10% yesterday. 1,200 recently, 2,500 is at least till yesterday. And there are many, actually, smaller companies. But, of course, they're all, you've got to focus on the technology and are they the cutting edge? And, I mean, not easy for the layperson to assess. I don't know if you've looked at any of these names.
I think very clearly post the recent geopolitical conflict, India's defense companies and their capabilities were tested, and they've actually come out in flying colors. So one of the things that, of course, war means negative. It means from life and geopolitical standpoint. But from a business opportunity standpoint, from a medium term, it opens up exports as an opportunity for defense to come through. That's something that we have been kind of mildly warming up to. We have been overweight into defense heading into the last few months, and not just the 2 leading PSUs, even beyond that. But we think that a good bit of that rally from a very near-term standpoint is kind of in the price. So we would wait for a bit of a pullback for us to kind of load up again. So to answer your question, structurally positive, Indian defense has come of age. Defense as an exports opportunity will probably kick into gear over the next 3-5 years. But near term, I think the markets capture a good bit of positives.
All right. Hi, Trideep. Good to see you, Ben. Trideep, you're positive on tech post the recent pullback. Tell us, what is your preference in that space?
So tech, in our opinion, at the moment is a game of expectations more than earnings. We think that, this is the worst possible time from an economic decision making from a tech, US and global standpoint. And hence, the expectations are very reasonable with regards to earnings overall. Valuations are also in line with that of last 10-year average within pockets. And hence, while we were underweight till about a few months ago, we have covered that. And incrementally, we would probably be looking at it, favorably as we get into next year or so, where hopefully Trump's tax cut plans in some shape or form comes into gear. And that would mean better days for US corporates and hopefully as a follow-on on Indian IT companies as well.
Trideep, what's the biggest house overweight? I mean, across schemes, across funds, if I were to ask you about the one dominating sector, what is it? I mean, is it the obvious financial services? Is it something else?
we are heading towards a meaningful overweight towards consumption, Sophie. We are probably not there yet. We want to time it in the sync with so that we get the right prices. Themes are all fine. We have to marry it with valuations so that we kind of get the best of both worlds. But I think we are heading towards probably better days in consumption in our view as we get to the back half of this year. I highlighted a few reasons, and our portfolios are gradually reflecting that conviction over a period of time.
And, consumption is a very big basket. So within that, are you talking QSR, FMCG, jewelers, shoemakers, or the whole play?
Consumer discretionary and the premium to start with. If the monsoon and the inflation going down sticks to plan, then maybe over time staples. But that's the sequence that we are headed.
Okay. All right, Trideep, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here. And really good to get that perspective as always. Well, I think the market is down about 35, 36 odd points at this stage. 24,780 at this point in time. I think, we can maybe just look at a few names here till I wait on, just our next guest. I think ITC is down about 3%. It's, by the way, the big volume-led loser. Of course, it's that block, which is, I think, very clear. There is BDL, which is down about 3% at this point in time as well. BEML, Bosch, NMDC are some of the other ones which are moving around. 50 down on the Nifty right now. Well, it is my great pleasure now to welcome Dr. Raghuram Rajan to our program today. Dr. Rajan needs little by way of introduction, but let me be brief. He is one of the world's most respected economists, currently the Catherine Dusac Miller Distinguished Service Professor of Finance at the University of Chicago Booth School of Business. He served as a 23rd governor of the Reserve Bank of India, where he was widely credited for bringing down inflation, strengthening the banking system, and introducing key reforms that have had a lasting impact on India's economy. Dr. Rajan's distinguished career also includes serving as the Chief Economist and Director of Research at the IMF. Dr. Rajan, great to have you with us here on the program. It's an honor, sir. Prashant this side. Dr. Rajan, if I can start by asking you whether, the good news on tariffs, when I say good news, I mean, this handshake type of deal that we saw between the US and China. It's not even a deal, as someone said, not even a framework deal, but at least an agreement to start talking. Or the one with the UK. Have we seen the peak of the good news cycle as far as tariffs go? And will things get more contentious into the rest of 2025? What's your assessment, sir?
Well, I certainly think that what we need to have is more certainty on where the tariffs will land. Right now, we have, as you just said, an agreement to talk. But at the end of this talking, what happens? And talking takes a long time. So even while people are talking, are tariffs going to go back to the Liberation Day level on July 9th, 10th? For the rest of the world, is it going to go back to the Chinese levels on August 10th, 11th? I think the sense is certainly the level of tariffs that were announced in Liberation Day are probably untenable. And so they will have to be negotiated down. But where and when is the kind of uncertainty that harms business considerably also. So a lot of businesses waiting to see, are they going to keep the tariffs, at least while the talk is going on, at the 10% level for most of the world, or is it going to go back up? So some certainty on that would also be most welcome.
Dr. Rajan, when financial markets do well, it kind of papers over a lot of other stuff, some of the underlying issues, etc. And if you look at global, the big markets, they're all a few percentage points away from all-time highs. It's almost as if tariffs really will not hurt. I mean, they're pricing in little to no damage because of tariffs. What is your sense? Is it possible we actually, escape any consequences, or do you think it'll show up? Not now, but maybe a little later.
Well, there is something somewhat funny about financial markets that as far as policy goes, especially when policy is as unpredictable as in the current situation, it seems to almost be putting a probability of 1 based on the current environment persisting. So when the US raises tariffs on Europe, immediately markets react negatively. The moment there is a discussion of a pause, they react positively. So I don't think markets are really pricing outcomes effectively. They don't quite know, and they're putting a lot of weight on continuity right now.
Just one more question to finish that loop. Do you think the tariffs are being used by the Trump administration as threats to negotiate, or do you think they're very ideological about this? And, as someone said, President Trump, in all likelihood, will not, this is his last term, so it's not as if he's standing for re-election. So he wants to effect change and bring manufacturing jobs, American manufacturing jobs, back to the States. So is this going to be a lasting theme throughout? Or do you think at some point, he's going to give in and then, watch the markets and the good stuff comes? What's your sense?
I think the tariffs are not going to go back to the old levels. I think there is some level which will stay, maybe the 10%, and certainly maybe more in certain areas like autos. And that's partly because of the ideological underpinnings of the current administration. They do believe the US has been unfairly treated by the rest of the world, but they also believe that tariffs can give the US a certain amount of sort of playing power. But I also think that right now with the tax bill, the big, beautiful bill under consideration, tariffs also play a role in being a source of revenues. And the US desperately needs a source of revenues to justify the level of tax cuts that are coming in the bill. So for all those reasons, plus the fact that I think it gives the US a lot of power because it's a big market for the rest of the world's goods, I think they're not going to go back to the old levels. The question is, are they going to be uniform across the board? Or are they going to be especially high for certain countries that are disfavored? And what is the longer-term certainty about the levels that are reached? Could it be that the administration turns on a dime and starts elevating them again for a country that it doesn't like or that has antagonized it? So I think a lot is up in the air, but almost surely we're not going back to the 3% level that the US was happy with before. It will be a higher level of tariffs.
Dr. Rajan, good morning, sir. Pleasure to be listening in to you, Surabhi here. I'm glad you brought up the big, beautiful bill. I have a two-part question. So we're looking at two very big sort of events playing out right now. One is tariffs and whether the Trump administration can bring manufacturing back to the US or not. The second piece is the US deficit. And the bill is only going to be boosting that further. In the near to medium term, let's say if you take a 2 to 3 year view, what is the big economic reset that you forecast for the US economy? And the second part of that question is, and therefore, do you expect a flight of money, maybe not a big flight, a small flight of money away from US assets, US treasuries, US equities?
Right. First, I think the short run tariffs are disruptive, even to manufacturing. So we will see the consequences in the second half of this year. Will it bring back manufacturing jobs? Probably not a whole lot, because a lot of manufacturing, even in India, has been automated. Look at a cell phone assembly line in India, and you see machine after machine. These are not people screwing in stuff into the motherboard. That job disappeared a long time back. So I think when the jobs come back to the US, to the extent they come back, they have to take into account the high cost of labor in the US, which means it's going to be largely automated jobs. And jobs that will be created will be for technicians who man the machines, not for the guys doing the work directly. So big increase in manufacturing jobs, unlikely. But in the longer run, I think one of the concerns this has created in the rest of the world is, are we overly exposed to the United States? And you can see it in the talk amongst financial investors. 70% of global stock valuation was in the US. And now people are saying, well, maybe we're overly exposed. We need to rebalance our portfolios, both on the equity side, but also on the fixed income side. Are we holding too much in US Treasuries? So when you talk reset, I think this portfolio rebalancing will play out for some time. It is one reason why the US dollar hasn't appreciated, even while there are global concerns about economic growth. It's because people are saying, do I really want to put more assets in the US at this point? And many portfolio managers are saying, maybe I need to rebalance, not necessarily because US growth is going to fall off a cliff, but because I just think I am overly exposed to my sense that the US exceptional performance will continue. I think more broadly, we're going to see supply chains move nearer home, wherever home is. That is a process that has been underway, but that'll get a special oomph under President Trump's policies.
Okay, so, sir, do you then see only a mild reset in market flows or in sort of investment portfolios? And what about the deficit? I mean, we're very used to it. Every year there's a debate on the deficit, and then, they sit on the fence. Eventually, the bill gets passed. Just a word on how you see that shaping up, and therefore what happens to yields?
I think it's not a mild reset. I think there is going to be a significant reset, especially as areas like Europe start considering whether they should be spending more, whether they need more financing. And Europe has been sending a lot of capital to the US. As Europe starts doing more infrastructure, as it does more defense spending, some of that financing will go towards financing European asset creation. And so I think there is going to be a global reset in portfolio holdings. And that will also be accompanied by price changes. You're already seeing a somewhat weaker dollar than anticipated at the beginning of the year. And that's something that could possibly continue. So this is on the cards. Sorry, what was your next question?
On the deficit and the direction of US yields, sir.
Yeah, I mean, look, I think the big, beautiful bill is not yet fully done. I think the Senate will have a role to play. And some of the worries in recent days, which has sort of shown up in higher yields, not just for US long-term assets, but also across the world, Japanese long-term bonds. I think people are very wary at this point about being locked in to longer-term investment in government securities, given the uncertainty about fiscal space, both in the US, but also in Japan, as well as Europe. So what this means is that you can't take US financing for granted. The US debt to GDP is crossing 100% net in the next couple of years. And add to that a wider fiscal deficit embedded in a big, beautiful bill. And there are some sort of fiscal engineering also embedded in it, which says some of the spending or some of the tax cuts will come to an end at the end of the Trump administration. That is probably unlikely. So when you put it all together, this bill has to satisfy markets that it is not totally irresponsible. And I think the Senate, including the Senate Republicans, will have to play a role there.
All right. Good morning, Dr. Rajan. Nigel on this side. It's an honor to speak to you, sir. Thanks a lot for joining in. Well, I wanted your view on India being able to get a fair share of the global supply chain diversification. Do you think a lot of MNCs will look to set up shop here in India?
Well, it could be India's moment. I think that certainly all supply chains are being reinvestigated by the firms that run them. And if India can put out the red carpet and say, we will have a predictable tax and policy regime, we will allow you to also produce for the domestic market, and don't worry about the pushback from Indian industry, which feels threatened. We will make sure these policies are in place for the foreseeable future. It could result in a significant increase in foreign direct investment. Of course, industrial countries don't want to see supply chains moving from China to India and not coming back into the domestic market. But if India plays its cards well and doesn't make it front and center all about subsidies, that it is about a better production environment and it offers a very viable alternative. And some of the states in India are very interested in doing this. I think if we can do that, it could be India's moment. But a lot more action is needed, and it has to be proactive, not just reactive. It is about creating a better environment in India for foreign direct investment, something we haven't paid enough attention to in the last few years.
Dr. Rajan, in that context, President Trump's almost warning to Apple, that we've tolerated you making in China, but now come back home. And the iPhones that you sell in America need to be made in America. How much attention should we pay to those kind of statements? And actually, the question is, how much attention will Apple pay, or other large global MNCs pay to something to things like this? Because I mean, companies have got to think beyond 4 years, right? Which is the presidential term.
Right. No, I mean, it would be the rare CEO who wants to cross the Trump administration at this point. But it is a negotiation ploy, not so much ploy, but there is room for negotiation. Apple can point to all the work it's doing in the U.S. and the profits it's generating in the U.S. as a result of its creation of new designs, new intellectual property, etc., and say that the manufacturing is essential in a cheaper place so as to get Trump products out at a reasonable price to U.S. consumers, but also to consumers in the rest of the world. That kind of reasonable argument has to be made, but also it does indicate the importance of not trumpeting the fact that you're coming away from China and putting it in India. There is a lot of value to flying under the radar screen at this point and doing what you need to, but also having a frank discussion with the administration on what can be brought back and what can't. Screwdriver technology, assembly, stuff like that is going to be hard to bring back to the US. But certainly Apple can say that there's a lot more R&D going on as a result of its ability to sell its products across the world. And that R&D happens in Cupertino, not elsewhere in the world.
I mean, global captive centers here in India has been a huge growth industry with, I think, pretty much all large MNCs here, American and otherwise. Dr. Rajan, let's talk about the trade deals themselves, right? So we've got one with the UK. The US one, I mean, we heard, I think there were some reports saying that over the next 7 to 10 days, we perhaps will get some sort of a framework deal, like an MOU, and then the actual stuff will take more time. What is your sense? I mean, on the India-US deal per se, but more also about these bilateral deals, right? Because these multilateral kind of setups, trading setups are breaking up. It's all sort of one-to-one, country to country. So just wanted your thoughts there.
Well, yes, it is unfortunate that we're not really talking about a global mega deal. But what I do hope is some of these bilateral deals create the kind of momentum which lead a country to think about the bigger picture. It would not be appropriate for India just to do, tariff deals with the US while inhibiting other countries from benefiting from that. It makes sense for US industry to have the same kinds of rights that, for example, European industry has, which then benefits India because it locates production, it buys for production in the best place possible for India. So, these bilateral deals could get converted into a more multilateral deal, and that would make sense from India's perspective. Now, as you said, these bilateral deals are really, interim arrangements, a statement of principles on where the negotiations are taking place. Actual trade deals take a much longer time to negotiate, while there is an impetus to do it quickly, to dot the I's and cross the T's will take more time. But I do hope that, bringing down tariffs with respect to the US gives the impetus for India to bring down tariffs more generally, and thereby reintegrating itself in global supply chains, which it has missed out on this may be India's moment, and it should use the negotiations to advantage, not simply be driven by the incentive to protect certain segments of Indian industry, but to make Indian industry much more competitive globally and take advantage of this moment in that way.
That's a strong point, a point very well made, sir, that this could be India's moment. We should not look at protecting specific pockets of industry. We should look at the bigger picture and seizing the global opportunity here. Got your point completely. So moving now to the general sense of monetary policy and regulation here. We're coming off from a phase where there was a sense being built up. There was a sense that unchecked, unsecured lending had to be regulated, and that was done by the previous governor. Since then, some of those prudential norms have been eased out, and now there's an expectation building in the market that we will be in the era of ample liquidity and perhaps big rate cuts as well. In your assessment, does India right now need that level of a monetary growth kicker?
Well, I don't usually comment on Indian monetary policy. I probably know less than I should about it. But let me set it in the global context. Outside the United States, the raising of US tariffs has been a negative demand shock. There's less demand for goods produced by the rest of the world because of the US tariffs. But also, it does give countries like China, which are big manufacturers, the incentive to look for new markets, which is also going to hold down the price of goods. China is going to look to Europe, to India, to other places to send some of the goods that are not going into the US. So all this means that inflation is less of a problem. Of course, there are India-specific reasons why inflation has come down, including the prospect of a good agricultural crop going forward. So for all these reasons, I think countries outside the United States have the ability to ease monetarily, and if that also implies easing on the liquidity front, that's a good thing. But as you caution, we have to also make sure that as we are enhancing domestic demand, it doesn't get imbalanced. We don't see pockets of excessive credit growth as we saw with the unsecured lending. We have to be a little careful as we expand, once again, that credit is reasonably well allocated, which means a continuing role for careful supervision and regulation.
Dr. Rajan, wish we could go on, but I understand you also have a tight schedule there at the UBS conference. I'm going to just ask you one last, if you will humor me, sir. You're at the UBS conference and you're meeting so many investors and so many people who are there. As you kind of sort of soak in all the feedback and all the commentary there, can I get one big non-consensus view from you, sir? What do you strongly disagree with that from everything that you've heard there? If I can ask you that.
Well, let me put it this way, consensus tend to build up, and because they're the consensus, they tend to be wrong. The consensus at the beginning of this year in places like Davos was, US exceptionalism, this is going to continue. And we've seen 5 months later that, it's going the other way. There's enormous skepticism about the US and its policies. And I would say that's again, a reason to rethink that maybe, all this plays out in a reasonable way. And at the end of it, there is still some sort of faith in US exceptionalism, the innovation, the energy in the US, is still maintained, maybe at a somewhat weaker level. You won't see that in current US policy. There is a lot of ferment going on in the US. Administration is trying to do one thing, the courts are trying to do something else. Things will settle down. But if there's one consensus right now, it is everything else is moving up, the US is moving down, and maybe this consensus will prove to be wrong.
It's lovely. And I think it's something we should pay attention to, and we'll keep the back of our mind when we conduct these interviews, because you're absolutely right. That seems to be the prevalent consensus view at this point in time. Dr. Rajan, we'll leave it at that. Thank you very much for taking out the time and joining us here on CNBC TV18. It's a pleasure, sir, and hope we can do this again soon. Thank you.
Thank you.
All right, we'll take a quick commercial break here. We're going to come back and we'll connect with the management of Hindustan Copper to talk about their fourth quarter earnings. It's a management you don't hear from very often. So Sanjeev Kumar Singh coming up in just a bit.
Welcome back. Well, let's have a very, very special management who joins us on the show, that of Hindustan Copper. The numbers were quite good. Operationally, things have been looking up. And the globe is quite bullish on copper prices as well as demand. To help us out with how he sees things going ahead, we have with us Mr. Sanjeev Kumar Singh, the Chairman and Managing Director at Hindustan Copper. Hi, Mr. Singh. Good morning. First of all, congratulations on a rather good showing. And we request you to join us more often on the show. Well, let's start off with the basics first. I'm looking at the commentary and you're sounding quite optimistic about copper demand. Could you tell us in terms of a price range, what kind of a price band do you expect copper prices to move? Because you're the only play on pure copper prices from a stock market perspective. And also in terms of volume growth, what are you factoring in for FY26?
As far as FY25-26 is concerned, copper prices are going to remain strong because of the demand. And it's a global demand, I should say. As far as infrastructure is concerned, the EV is concerned, artificial intelligence, whatever you talk, anything green energy, it is copper. So demand is very strong, which will convert into the strong prices.
Okay, you want to give us a price range, sir, that we should be working with, given that demand is going to be strong? And as I asked you, can you give us a broad sense about how your volumes will scale up? Last year, as you'll put out in a press release, it was fairly, very good in terms of a volume growth. This year, on the base that you've delivered for the FY25, what kind of a volume growth can you deliver?
Volume growth in sense of the ore production, you mean to say?
Yes.
Yeah, we will definitely be going plus 4 million tons in 25-26 as far as ore is concerned. And as far as MIC is concerned, definitely it will be plus 30,000 metric tons.
Okay, all right, 30,000. So ore of 4 million will compare with around 2.73 million, if I got that correct.
No, I'll just clarify. 2.73 is the production of one of my mine. There are 2 locations and 3 mining sites. Total production was roughly 3.5 million tons this year, which will scale up to 4 plus. So there will be a growth of 15% from the ore point of view. And from the MIC point of view, that is metal and copper, it will be from 25,000 to 30,000. So there also you will see a growth of more than 15%.
Got it. All right. So volume growth for the year will be in the vicinity of close to around 15%. Could you help us out? Yes, sir. Could you help us out with copper reserves? What is it currently, in terms of already discovered reserves that you have? And since there will be a lag in terms of a timeline, we have seen globally as well, to ultimately get to those reserves, it takes quite a lot of time. Those timelines have got elongated a little bit. What are the measures that you are taking to go ahead and discover more of the reserves?
I like to put in this way. For last 3 years, our emphasis has been on deep exploration. 3 years back, we started exploring our own sites. And in last 2 years, we have added roughly 123 million tons of resource and reserves. And we will keep on exploring deeper than 1 kilometer. And we'll adding the value of reserves and resource in this way. This 755 million tons is April 24. These years' figures have not come. It will add another 15 to 20 million tons more to what I'm saying. So Hindustan Copper is focusing more and more on deep exploration. For this, we are in touch with foreign companies also.
Okay, and the last recorded reserves number that you have is how much, sir?
It's 755 million tons, April 2024. The figures of this year are going to come shortly.
And it could go up by around 20 million is what you're telling us?
Yes, definitely.
All right, and will you be partnering more with private, MDOs to go ahead and, dig deeper? And, what kind of partnerships have you already struck?
Recently, we have awarded one of our mine, Rakha Chapri, in the MDO mode in a revenue sharing. In fact, I like to mention this is the first mine outside in the metal sector to go for the revenue sharing method. It's a long-term contract of 20 years. Further, it can be increased to 10 years. And they will be producing the peak rated capacity of the mine is 3 million tons. So this will be a new restarting of the product. This was the old mine of ICC group in Ghatshila region. So this will restart. This is one of the mode. And in other mines also in the Ghatshila region of Jharkhand, they are going to restart very soon. Within 3 to 4 months, another mine will restart.
You're also talking about reopening the Rakha mine. Is this the same mine?
Yeah, Rakha mine. It's two blocks, Rakha and Chapri I mentioned, but basically we say as a Rakha mine. Very true.
So Rakha mine reopens in the next 4 months, so sometime in the middle of this fiscal?
No, it will be in the last quarter, but restarting doesn't mean it will add to the production this year itself, but there is another mine which is known as Kendadi. This will add within 6 months the production.
All right. For this kind of capacity enhancement that you're planning, what kind of a capex plan, sir, have you laid out?
Yes. The capex plan are quite huge. This year will be at least 350 crores, I should say. And it will go on increasing every year, I should say.
And the capex
I would like to mention here in Rakha, we are not going to put more money into that because it is in the MDO mode. The whole money will be brought by the MDO itself. But in other mines, I just mentioned we are going to put up a new concentrator plant. We are going to deepen our mines. So these development activities will need at least 350 crores of rupees this year.
All right. Rakha mine, you'll have got into that deal with Southwest Mining Limited, the Jindal Group.
Yes.
Got it. All right. And all this capex will be funded via internal accruals because you're throwing up cash flows of around 500 crores plus, right?
Internal accruals plus, you just seen yesterday, we have got approved that 500 crore bonds. We have got a lot of means. Funding is not an issue. We don't have any loan on our books, you can see very well. So the funding is not an issue for Hindustan Copper.
Yes. What kind of cash you have in your books as of now?
About 115 crores, roughly.
115 crores. Got it. And plus you're adding cash flows. What about margin outlook, sir? Could you give us, some kind of an analysis with regard to how do we see the margin trend going? Or if you want to, put up at these copper prices, this is the kind of margin that you can make. A broad analysis will be good.
Yeah, definitely. See, if you on these copper prices, because our copper prices are governed by the LME prices, you see, our EBITDA margin, if you see, it has increased from 36, 4 basis points, it has increased from 34 to 38. So this signifies the operational efficiency of Hindustan Copper also. And you just see the profits of, if you compare with the last years in the totality, the PAT has gone from 295 crores to 468 crores, and PBT has gone from 410 crores to 633 crores. So the numbers themselves speak of the performance of the company.
Okay, so at current prices, and given that you're optimistic on pricing, what kind of a margin band should we work with, sir, for this year?
It's very difficult to say, but the same figures which are going on.
So around 35 to 40% is doable?
Definitely. In fact, we will improve on this. I assure you, we'll improve.
More than 40% margin for this year, correct?
Yeah, very right.
Final question, sir. Since we have you and you rarely talk to us, we hope that changes. But there is some buzz in the last few years that Hindustan Copper could be one of the divestment candidates, or the government could be looking at selling out the company. Have you heard anything, or is it not true at all?
See, on this, I can't speak at all. I can only add to this. This is a divine metal company. We are sitting on the divine metal. The copper is a divine metal. And Government of India, Ministry of Mines in particular, is helping continuously in all aspects, not only reopening of the mines, expansions and exploration. So Honorable Minister, Ministry of Mines, everybody is helping Hindustan Copper. This is what I can add to it.
So it's not a divestment candidate because of all that you said.
I can't say about that. I can only say I earlier mentioned copper is a divine metal. We are working with the divine metal. That's all.
All right, sir. We appreciate you joining in. Volume growth of close to around 15% for the year. you're looking at margins in excess of around 40%, capex plan for the year of around 350 crores. All of this will be funded by internal accruals. It's a pleasure talking to you, sir. I think the street likes what you had to say because as we had the conversation, the stock has moved to the high point of the day. New listing.
New bell rise. By the way,
divine metal was a new way of looking at it.
I've heard it being described as Dr. Copper.
Yeah, but it's a divine metal now.
But it is a divine metal. And fascinating conversation. And I love the excitement that the management brought on board. So that's Hindustan Copper for you. Bell rise is the listing which we're going to focus on. I think started about 12-13% higher. And there were pictures coming through from the exchange, the ringing of the bell, etc. I think it's 10% on bell rise. 8% now, so it's a very good start on a day when the market broadly is lower. What we'll do, of course, is we'll get our research analyst to come in and talk to us about Bell Rise, what evaluations that post the listing, comparables, etc.
Maharashtra-based company into lots of different formats of engineering, part of the engineering chain. Among the things that it's making is sheet metal, casting parts, polymer components, suspension, mirror systems, etc. So
all the right spaces.
Big player in the auto component space as well. That's about 10%. That's Bell Rise Industries. Well, on that note, let's actually go back to the market and take some technical calls as well. We've got Mitesh back with us. 60 points lower on the Nifty right now. Mitesh, hi. I'm talking to you for the first time today, so good morning from my end. How do you assess things and what's the trade now?
Good morning, Sulvi. So, earlier in the day, I was talking about the fact that markets might be range bound and we might see consolidation going on. I think that process is still on, so not much happening, to be very honest. But trading on the stock-specific side, I do have a sell on Aurobindo Pharma. That's a stock which is slightly turning negative. So keep a stop at about levels of 1188 and look for a target of around 1120 to begin with. And the other one which I like is Deepak Nitrate, where I would recommend buying with a stop below levels of 2040 for targets of around 2130.
Okay. All right, Mitesh, thanks very much for that. We'll connect with you later during the course of the day. Need to take a break right now. On the other side, we get you excerpts from our exclusive conversation with Federal Bank MD and CEO KVS Manian on the quarter gone by and on the impact of tariff uncertainty on private capex.
Okay, welcome back. Let's get an exclusive conversation going. Remember, the fourth quarter earnings season is almost coming to an end. And my colleague Shireen Bhan spoke with KVS Manian, Managing Director and CEO of Federal Bank, and talked about the outlook for the bank, for the sector going forward. Mr. Manian also spoke about the impact of tariff uncertainty on private capex, Spain and the MFI space, and much more. Listen in.
Let me start by asking you about what the outlook is for banks, specifically yours, and for the industry in general, in light of what we've seen with liquidity, in light of the possibility of another rate cut, etc. What's sentiment looking like today?
So, Shireen, liquidity is better in the system, and that is good news for the sector. Having said that, we know that policy rates will be cut, and that also means that most banks as a sector will go through some spread compression because regulatorily now 50-60% of the book in any bank is linked to repo rates. So there will be some rate pressures initially. Of course, as the deposit costs catch up over the period, there should be relief on spread compressions. Having said that, I think in general the assumption is that economy remains in good shape, and one can argue whether 6.3, 6.5, but a six-handle growth in the economy continues. And if that continues, I'm assuming that overall prospects for the sector remain.
Speaking of overall prospects, we've got an early onset of the monsoon, even here in Mumbai, for instance, and the expectation is that all of this will bode well as far as consumption, etc., is concerned. But On private capex specifically, because that question mark continues.
Yes.
What is the sense that you're getting in light of the fact that we're now in an increasingly volatile and uncertain global environment as well?
Right.
Is that impacting sentiment even further on the private capex side?
So, we've been seeing green shoots on some sectors, but a consistent private capex has not happened. And I think some uncertainty on the tariffs and where it goes does play into this. And my belief is that unless there is clarity on how that is going to play out, I think some capacity creation will wait to see how that pans out.
So pause, wait and watch, that continues to be the feeling?
I would say there is some pause, wait and watch based on how these tariffs, the overall tariff scenario plays out, yes.
Let's talk about the MFI space as well, because that has been a point of stress which has been acknowledged by many banks, including yours. Is the worst behind us? Are we starting to see a, course correction?
Yes, beginning to see some improvement, but I would say still not, I would say another quarter or two.
Of pain?
Of some pain, yes.
Of some pain?
Yes.
But you
maybe improving, but to see the bottom of the problem, I think we are a quarter or two away.
Still a quarter or two away.
Is my feeling, yes.
And specifically as far as the gold loan side is concerned, the RBI draft guidelines, you have an exposure in the gold loan market also. What do you see as the implications, the impact of the draft guidelines that the regulator is looking at?
Yeah, the draft guidelines are quite good. Actually, they level the playing field in all ways. So therefore, we see the draft guidelines as a positive development from our point of view, because it also makes the LTV norms common across whether NBFC banks, all of that. So I think it makes the field more level playing, and therefore it's positive.
The deposit fight, and it seems like the banks have won this round at least. What's the sense on that?
Yeah, so if the liquidity is good, I'm more positive and sanguine about the deposit growth scenario, and liquidity is getting better, as we can see. And of course, the rates are lower, and that's not necessarily good for deposits as a product. But two things. One, if there is growth, and if there is then I see banking sector in general doing well, and therefore attracting credit side growth as well as some deposit side growth. And I'm reasonably positive on the growth side. Second is, if liquidity continues to be good, which is what RBI's intention, clearly stated intention seems. If it remains good, I think it is good for the sector. And overall, banks will still manage to grow their deposits during this.
You talked about factoring in or baking in at least another cut as far as the MPC is concerned. June
cut 6th, or two.
A cut or two. Is that what you're going with?
Yeah, at least just now the base case is that there is a 50 basis cut from here in 2 steps, whenever those 2 steps through the year are, and hopefully that's the bottom of the cycle, is the base case assumption. Of course, we don't know whether there are more cuts than that. That will be looks unlikely today.
Yeah, I think the street is factoring in two cuts as well at this point in time. Savings rate cut. HDFC Bank moved SBI holding. What's your take on that?
No, but SBI is already at 2.7. So we cut our rates as well to 2.75. And see, there is not that much wiggle room there, but can it go to 250 maybe? It will.
So a matter of time, you think?
If 50 basis cut comes, yes, it's probably a matter of time.
So overall, at this point, what do you see as the tailwinds, but also what do you see as the most significant headwinds that you're bracing yourself for?
So tailwind is, of course, the economy at 6.5% growth rate is the tailwind. But headwind is, of course, if the growth doesn't translate into credit growth. Because at least the many economists have penciled in a growth rate just about the same, or maybe some of them are even penciling a slightly lower growth rate on credit. So that's where I think the headwinds can come, whether it translates into the right amount of credit growth or not. That could be the headwind.
Okay, 50 points lower on the Nifty is what you have. Interesting conversation. And of course, we'll play out snippets of that conversation with Mr. Manian through the course of the day. Let's shift focus to commodities markets. And Manisha is here with what is top of mind for her. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, I'm looking at the crude oil prices right now because we've seen a bit of a gains here. But remember, it's going to be a very, very interesting and important week as far as the crude oil prices go. Well, to begin with, it is OPEC and allies meeting, and a couple of them slated for this weekend itself. So on 31st of May, it is a OPEC and allies, OPEC plus ministerial online meeting, which will talk about production going forward and as far as July and perhaps beyond as well. And then 8 of those OPEC and OPEC plus members will meet on 31st of May yet again, and they would talk about on whether or not they can keep up with these production quotas that have been assigned to them. So interesting cues coming there. Remember, OPEC has started to increase production and intends to increase it to 2.2 million barrels per day by the month of November. Apart from that, we also have seen Iran hiking prices for Asian buyers for the month of June. This is $1.8 a barrel above the Oman averages that India buys in there and most of the Asian countries as well. So that also seems to be supporting the prices. And US has been talking about potential new sanctions coming in on Russia if that ceasefire or the conversation between Russia and Ukraine doesn't happen soon enough. So that is yet another thing. And then the markets also are looking at impact perhaps from US barring Chevron from exporting crude oil from Venezuela. Remember, those sanctions have come in for Venezuelan oil exporting companies there. But US also says that Chevron can continue to hold its assets in Venezuela, but it cannot expand any more activities within that country. So various stuff happening around the world, and that has been keeping the crude oil prices around that $64, $66 per barrel mark. Markets also are then looking at Iran conversations. Remember, we have seen 5 rounds of conversations also already happen. Now, Iran says that it is open to compromise on its nuclear program in talks with the US, but Iran also says that it should be allowed to continue to process its interest in sense of nuclear energy there. So that conversation, while on the positive side, but still is far away from having happened there. The markets then also are looking at Baker Hughes' report, which suggests that there is a constant decline in US oil and rig count. It's to the lowest since November 2021 right now. So this whole conversation about US will increase production a lot isn't really happening, and that's what's supporting the markets there. As I said, OPEC allies meeting is something that the street will watch out for. But apart from that, it also is about the Fed policy meeting minutes. Well, that gets released today. The markets also will watch out for the first quarter GDP numbers from US. It also is about the PCE data that comes in on Friday, and then weekly jobless claims numbers. So lots of data, lots of meeting events, and then, of course, those statements from US are never ending. All of that impacting the crude oil prices right now.
All right, Manisha, thank you very much for that. That is the triggers to watch as we go forward. We'll take a quick commercial break here. We're going to come back in just a bit from now. We'll have the management of Balrampur Chini joining us as they sort of start production and establish the first polylactic acid plant. It's a project they've spoken about in the past quite a bit. It's coming up in just a bit.
Welcome back to Bazaar Corporate Radar. Let's shift focus now, and joining us is Balrampur Chini Mills MD, Mr. Vivek Saraogi. Remember, the company has signed an MOU with the UP government to establish its first polylactic acid plant with an investment of almost 2,850 crores. Mr. Saraogi, hi, many congratulations. And what really led to a sugar and ethanol company going in for bioplastics to begin with?
Maharashtra being the largest contributor to GDP, and Maharashtra and Gujarat house the maximum MSMEs, our pitch to the Honorable CM was to declare a policy for adoption of bioplastic for the MSMEs. We know his passion for, plastic and the problems caused by plastic. So he also reiterated his thinking, and that was the idea. And to get all the stakeholders in a single room.
Mr. Saraogi, so to begin with, what is the overall capacity for this? The investment numbers, of course, have come out in the press release, but what is the thought behind and what are the numbers looking like right now?
So as informed earlier, it's 80,000 ton capacity in UP with a capital outlay of 2,850 crores to be commissioned in October, November 26.
Mr. Saraogi, we do understand that when it comes to climate change and renewables and bioenergy, bioplastics even, there is a lot of support and incentives from the government. At currently, the kind of government regulations and incentives that we see, how are you making use of that?
We are seeing a lot of interest both from the central government and state governments. And we're interacting with Ministry of Environment, Ministry of Chemicals, who's our nodal ministry, so as to Department of Biotechnology, that's DBT, under whose stewardship this Bio E3 policy was declared. And I think we are making good progress.
As is with everything, what are the challenges that you foresee onto this one and how are you dealing with that?
Basically, it's to get the two sides to it. It's to manufacture the 100% capacity of the right quality. We do definitely feel confident. We have the best technology partner, Sulzer. And the other side is to sell it at the correct price. We are working on that and we're making very good progress. And I'm very hopeful there also. We're hopeful on both the sides. Two separate teams are working on each direction. So it's to manufacture at the correct cost and be able to sell at the reasonably correct price, therefore giving us our margin to enable us to, if successfully done both, and why if I.
Mr. Saraogi, also enlighten us on the overall market that is there to bioplastics and what is the entry or what is the market share that you are focusing on here?
We would definitely look to enhance our capacity. And the market is huge. It's in millions of tons. It's 4 million tons. And we're talking 80,000 tons. So that's the market. The single-use plastic market, and again, is huge. Avantika will give you the details. So everybody says we want an alternate product before we're able to enforce the legislation. So that's how we feel. Once we engage with them and show them the production, it will be quicker. But I'm confident. The interactions with the buyers, converters, policymakers, all are giving a very positive vibe.
All right. I will talk to Avantika about this in detail. But since we have you with us, I also want to talk about sugar and ethanol. And ethanol price revision is long awaited. Last couple of years now, I do understand that sugar as an industry has been making a lot of presentations on this. Where do we stand on that right now?
This problem has cropped up in the last 2 years. The first was the election year, which I think as an industry and responsible industry, there was fear in the mind of government. And therefore, that 1 year was well accepted in our minds. What happened last year was not par for the course. Now we are engaging very deeply with the government. They also, I think, have understood that if they are to sustain this, they would have to match FRP and ethanol pricing. I think it should get back on even keel. However, the timing for that would be September, October. That's when that price is usually declared. So I think I'm very positive. But, last 2 years, 1 year, I've explained, the last year was a bit of a shock. It is digression from a well laid out, well-run policy over the last 5 years.
Oh, well, that point is well taken. Mr. Saraogi, what about the sugar exports? And last year they were banned, and this year we saw them start a bit hesitant onto that one. But what are the exact numbers now of the sugar export done from the country? And also minimum selling price of sugar is yet another thing that has been on cards, desired by the industry. What are the conversations, the latest updates on that?
8 lakh tons have gone out against a export quota of 10 lakh tons. 8 lakhs would go out contracted. I think 6 plus has gone out. And your second question was on MSP. So again, this is going to be part of the same same policy paper. They would do it together. But yes, MSP is lying on their desk for a lot longer time. So we are pushing on both the sides.
Mr. Saraogi, a final question then. And while this year for sugar and ethanol has been slightly jittery, we also do understand that ethanol more is about grain and less about sugar right now. But how is the next year's season looking to you? The monsoons have been good. The sowing numbers seem quite strong as well. So any numbers that you can share from next season?
Yes, that definitely would, in my mind, encourage the policymakers to answer this question of ethanol pricing. So I would also feel that, 5 million tons of diversion to ethanol would close the case. I don't think we'll be then staring at a surplus. We have capacity, and we will next year have enough cane to be able to do that 4.5, 5, which should be the maximum available surplus. So if we look at pre-ethanol diversion, I think 330, 335 would be or 33, 33.5 million. If you divert 4.5, you won't be left with any surplus. So that would not then trouble the sugar pricing regime. Having said that, ethanol price must be done to encourage that diversion.
Maybe take that point. Mr. Saraogi, thank you so much for joining us here at CNBC-TV18 today. Many congratulations again for that new leadership role that you're playing when it comes to bioplastics and, of course, talking to us about sugar, ethanol and the way going forward. Well, with that, it's a wrap on Bazaar, but Chartbusters comes up next.